All right. Good evening, everyone, and welcome to the Board of Finance regular meeting for February 15th, 2022. I want to recognize and thank SCTV for filming this and our clerk, Mary Lynette, for recording the minutes. Let's begin with the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. We have first on our agenda budget discussion, but we had a request to rearrange our agenda because Fiduciant has another appointment at 6:45. Is that right, Chris?
We do, and thank you for the opportunity, Lisa, to rearrange.
I just want to recognize Susan Salina from the Board of Ed, who is here and as an invited guest, as well as Wendy and Maria, for the budget discussion. And I apologize. I was hoping to do that first so that we could get you guys out. So if I just want to confirm that that's not a problem for the three of you.
Yeah, it's not a problem for me.
Okay. All right. Okay, go ahead, Chris.
Oh, great. Good evening, folks. It's good to see everyone and trust everyone as well. Bear with me here. I'll just get this. Folks, see our slide deck okay?
Yes.
Yes.
Okay, well, great. Again, good evening, folks. And again, thank you for the accommodation. Tyler and I think can be pretty quick, cutting to the chase here with the update. And I know we've got a good deal of overlap with the retirement plan subcommittee. So we'll obviously be respectful for those folks who hadn't heard any updates yet and get you the important points and kind of get you on your way. So really, we wanted to touch base on a couple of fronts here. We did just quickly, before we introduced the pension plan portfolios and the OPEB trust and performance figures through the end of the calendar year, just to level set quickly for the group this evening. I think, as everyone knows, the narrative surrounding markets has become a good deal more tenuous over the last few months. And I think, as you all know, certain of the factors that are probably figuring most prominently in some of those concerns center on an evolving Fed message, right, and the reduction of stimulus out of the system, which is ongoing and persisting, heightened geopolitical risks, the lingering effects of the pandemic, inflation that's running at levels we have not seen in quite some time, of course, and you mix that all together, and certainly that can make for some consternation, and we've seen that in markets a good deal as December came to an end and much more acutely into the new calendar year. And I think, as we've always talked about with the subcommittee, and I think we've reminded the Board of Finance in our annual update sessions as well, as you know, we're big proponents of diversification, and the construction of all your portfolios follows that tenet. And kind of on the margin here, as we mentioned in our collateral here, being kind of adaptive and flexible in the new year will be important. We'll obviously stay in front of those themes and trends on behalf of the town and make recommendations along the way. But what we've seen recently in the new year, certainly the heightened capital market volatility, and moreover, this idea that maybe returns are poised to moderate a bit here for a period of time on the heels of a very strong run, or kind of our running themes, if you will, as the new year continues to take hold. Just as a little bit of context for the full board in terms of capital market returns for both the fourth quarter of last year and for the full calendar year, I think it's readily evident, but you see in the visual exhibit on the top half of the page, starting with fixed income to the left, us just cataloging returns across most major segments of the capital markets. And I think the takeaways here, two or threefold, probably most noticeable, you do see there fairly dampened returns for fixed income or for bond investing in both the fourth quarter and the full year. Those markets, as you know, were challenged by or confronted by really interest rates that moved higher pretty steadily as the year progressed. As you may all remember, higher interest rates are the enemies of total return for fixed income. So pretty dampened year on the fixed income front. Those asset classes constitute about a third of both the pension assets and the OPEB trust assets, and we'll bring that in a little bit more concretely momentarily. Global equity markets with momentum in the U.S. markets, particularly in the fourth quarter and the end of the year, as you see there in the middle of the exhibit, back to this predominance of large cap U.S. equities for the year, which had a very healthy year, but you see decent returns both for smaller company names here in the U.S. and for the developed markets overseas, not so much in the emerging markets, right? As we had the challenges of a lot of headline risk, if you will, in China that's navigating somewhat of just an innately slowing economy, and moreover, some of the regulatory actions being taken by authorities there created some pressures and challenges, and there was some contagion effects into the other emerging markets. So a down year for those securities, although in calendar year 2020, actually emerging markets are the best relative performers year to date. And then things like commodities and REITs and the backdrop of higher inflation, as you all know, can be a tailwind to those types of markets. And you do see there some better returns in the upper right-hand corner of the exhibit. So that we just wanted to quickly catch the board up from a context perspective. We've got displayed on this next page for you the allocations across the three pension plans, town, board of ed, and police. Just as a reminder for the board, each of the portfolios shares the same allocation and the same roster managers there, and really to the far right, the same target weights. And we'll talk momentarily a little bit more to those targets in just a minute and what they mean and how we treat them. But you see otherwise allocations running by and large close to target, not identical weights in each plan, right? Because we've got varying cash flow needs across the three plans individually, but pretty darn close. And really no concerns from a larger allocation perspective. One of the other things, just for the edification of the full board, that we talk to the retirement plan committee about regularly is working up and down the roster managers in the column to the left, and really leveraging our very large scale research team that's talking directly to these managers on your behalf, each and every quarter and more frequently as necessary. And assurances as we sit here this evening that the rosters are by and large in good working order. And when we spoke to the retirement plan committee recently, there were no recommendations or calls for action on those fronts. So that is how the three pension plans allocate and continue to allocate. If we switch gears just quickly, we bring all those three plans together for purposes of just summary presentation, and the numbers we remind the retirement plan subcommittee about are center in the middle of the page. And you see there the trailing performance exhibit. And the way to read this is I think obvious, but maybe bears just a quick comment or two. You'll note for the fourth quarter, the plans returned about a 4.1% return. The broad benchmarks that we use as guideposts for the way the plans are allocated and kind of for the strategic mixes that are in place, you see they're returned in that same period about 3.5%. And then you can run off longer term top line numbers versus benchmark. And these are net of the manager fees. And you see there certainly in a vacuum, right, fairly compelling absolute returns over the last decade or so, and reasonably competitive relative returns as well. So I think, as we assured the retirement plan subcommittee as well last week, or when we last met, think we're in pretty good working order on pension plans, and a proof statement here in terms of performance and its consistency, kind of an additional validation. Let me just quickly skip to the OPEB and share those same stats with you. Then I'll pause for a minute and take any questions. And then we do have one other topic quickly for the board's edification this evening. The OPEB trust, you see here a great work that the town's done. We always remind everyone that you're certainly well ahead of many of your peers statewide, and $23.5 million of invested assets for those obligations is certainly commendable. The retirement plan subcommittee has long held a notion, and we endorse it, of this pool being entirely indexed. So remember, we looked at the roster for the pension plans that mix indexing and active management. For the time being, the OPEB is all indexed. You do see there in the target allocation column, in from the right, the larger allocations at the asset class level are not all that different than what the pension plan is using. Very diversified from a style of investment and an asset class perspective, and being done so at a fairly reasonable cost as well. So you see that mix and configuration of assets being in good working order at the end of the calendar year. And then moreover, just that same series of performance metrics for the OPEB trust. So again, down in the trailing performance summary, you see there the quarter of about 4.6%. You see the 1 year number, and then you see the longer dated numbers as well, kind of running off, as you would expect, largely in line with the benchmarks, right? Because it is an all indexed framework currently. But certainly, all things considered, right, in a portfolio that's been 2/3 equities, 1/3 fixed income, or thereabouts, an 8.5% annualized total return over the last 10 years is, certainly something I think that validates this construct as well, and what the OPEB's trying to achieve. So those are, we wanted to catch you up on markets. We wanted to catch you up on both pension and OPEB. Let me, Lisa, if I could, I'll pause there and see what questions the group may have. And then we can maybe segue into just a quick touch point on some of the actuarial information. Anything?
I'll open it up to board members. Is there any questions? Chris, just one sort of administrative thing. We had talked about doing executive summaries, and you worked up a wonderful prototype of that. But just to remind you, if we could get those.
Oh yeah, I'm sorry, Lisa. I think that was it's on the docket. Let me check the status of that. And the minute it's done, we'll send it over.
Okay.
Absolutely.
And then the second question, you had mentioned the diversity of the funds enables you to deal with liquidity needs, because obviously the town and employee contributions don't always cover the distribution. So we do have to liquidate. And I know our actuary did mention that as a risk, not specific to us. And in fact, we're doing a good job with it. But could you speak to how we handle liquidity needs?
Sure, absolutely. I'm going to just skip back here. So I think, right, each of the plans is, as alluded to, right, have their individual needs, and we need to be mindful of liquidity. And one of the things in I guess the balance we're trying to strike, right, is having ample liquidity to meet near-term needs, but not having too much in the way of outsized liquidity that stands in the way of the return profile and potential for the portfolios, right? So you see across the very top of the exhibit here, we're warehousing that liquidity in a money market account at Wells Fargo, and we're typically holding anywhere between 2 to 3 months of liquidity, and then as it self extinguishes, right, we will kind of replenish it, and the basis for replenishing that, as the board I'm sure can appreciate, is we're kind of testing existing allocations versus those target allocations in the far right-hand side of the exhibit. And no surprises, right, that all the other things equal, will source needed monies from those overweight segments of the portfolio. And it introduces an additional discipline, right, just in terms of staying centered on your target allocations, and not getting too far out over our skis in terms of over and underweight. So I think, Lisa, the answer twofold again, right? Trying to be very thoughtful with those raises, and keeping them at a level that doesn't inhibit the return profile of the portfolio more largely, and moreover, does it with a frequency, right, where we're not constantly in the portfolio raising monies, right? So that's kind of the balance that we're trying to strike. Just as an additional point of clarity for the board, in both the case of the pension plans and the OPEB trust, these are next day available monies, right, across the entirety of the portfolio. We're using institutional funds here to express the strategies, with Barings being the sole exception in real estate. But we can get at 95% of the portfolio next day and turn it to cash as need be. So they are very liquid solutions as well, and that's by design.
Thank you. And Chris, just to confirm for the record, the 2 to 3 or the 1 to 2 months of liquidity holding, that's industry standard.
Very typical. Yep, very typical.
Great.
To hold a couple of months for mature systems or plans like the townhouse.
Perfect. Are there any other questions from board members before we move on?
Yeah, this is Linda. I just want to make sure I'm understanding correctly, looking at page 11 and the prior page, that what you're saying, Chris, is that looking in the rearview mirror, we've done really well over 10 years, averaging 8.5% return each year. Trailing performance summary, I mean, on average.
That's
right?
correct, yes.
And so the real question for us is going forward. And I think that Lisa's asked, additional input from an actuary, Lisa, or somebody that else that's in the predictive mode. But I'm interested in your thoughts too, because the market and the world is changing drastically. And while we've done really well in the past, I don't know, my husband always says, never confuse brains in a bull market. So I'm hoping that we have both brains and a bull market going forward, but I think we may only have the brains and not the bull market. So I'm interested in your perspective.
So I'll defer to the chair there. It's a great segue into the remainder of the content on my side. It's exactly what we intended to cover. So
Perfect.
Here, folks, if things don't resonate. So we talked to the retirement plan subcommittee about this at our last meeting, and just to level set once again, I think, Linda, your intuition is spot on, right? On a go forward basis, our challenge, of course, is to understand what's happened in the past, but to be mindful of current circumstances and kind of on a go forward basis, what the prospects might be for the capital markets. And I'm not going to go through, in the interest of time, all this detail, but this is the framework we establish at the end of every calendar year. Basically serves as our guideposts, if you will, and our footprint for promulgating our capital market expectations and what we think on a go forward basis markets may deliver. So again, in the interest of time here, I'll leave it to the board if you're inclined to read this, but this is the basic kind of the tool sheet we use. And we take that and we develop forecasted returns across the entirety of the capital market spectrum. We're showing you here our 10-year outlook. We also show 20-year numbers. I'm sure that Jen will kind of reiterate this. We spend more time thinking about, right, and being mindful of the 20-year numbers, kind of given the circumstances of your pension plans and knowing that they're long-term vehicles with pretty distant investment horizons. So this all gets mixed in here. You see here underlying asset classes and our year-over-year changes and expectations across those asset classes. We take these numbers and data as the inputs and the target allocations that we introduced just a moment ago, and we put them into our optimization framework. And I kind of always apologize for these pages because they are very busy and they're not entirely intuitive, but let me try to help tease out here for the board kind of what we're trying to do. You see, we've highlighted in the upper left-hand corner with the light blue shaded line, the existing pension plan mixes across asset classes at both a high level, a larger allocation to equity and other risk assets versus fixed income. And then we delineated even further, as you see there, kind of under the hood with greater granularity in terms of the actual individual mandate allocations. And those numbers I just showed you form the basis for what we expect the portfolio should be able to do at its target weights on an annual basis over the different forecast horizons. So the takeaway here, I think, is obvious, but you see the current mix with our latest assumptions equates to an annual return of about 6.9% per annum. I don't know if everyone can see that there, the annualized return forecast in the upper right-hand corner of the page. There's some associated volatility and other risk statistics there that we monitor and keep tabs on. And I think, Linda, your observation is a good one, right? Look at the disconnect between, on a go-forward basis, our forecasted return versus what's actually been achieved from that allocation historically, and it's a clear 2% lower, right? So I think the intuition that markets may be a bit more challenging on a go-forward basis is a sentiment that we share honestly, and is, you know, kind of something that we're mindful of and certainly are attending to on behalf of the town in terms of monitoring the portfolios and opportunities for return. So that is kind of where we stand today. I know Jen is going to offer some additional perspective in a moment or two. The other takeaway here, and it's a nuanced one, and I'll try to keep it big picture and not bore you with all the gory detail, but the mix of assets you have, we also tested statistical optimality. And again, that's a lot of gobbledygook, but you see there visually on the bottom half of the exhibit, across the entirety of the capital market spectrum, when you bring together different assets in a diversified manner, we want to be certain that the portfolio is plotting on that so-called efficient frontier, which I suspect is a term some of you may have heard just in terms of how people think about and build investment portfolios. And the allocation for the pension plans indeed do plot on that efficient frontier. So I think the takeaway for the board, hopefully, is the current mix is statistically optimal and desirable. And moreover, and Lisa, Jen will offer her perspective here in a minute. We think that the 6.9% versus your standing 6 5/8 target puts you in pretty good working order, right, in terms of your current allocation. Could you, on the margin, take a little bit from equity and put it to fixed income? We think you could, and still be safely and aligned with that 6 5/8 number. I don't know that you absolutely have to do that, but it's something we can certainly over time talk to. And that, I think, is kind of the takeaway there for folks. We're always trying to build portfolios that are kind of aligned with the actuarial consideration. And at least from our standpoint, this is our assurance that I think that your standing allocations for the pension plans are in pretty good working order when you triangulate on all those different considerations.
Chris, if we go down to 625 on the assumption, we could obviously reallocate some of the equity more than just at the 6.5, right? And what would that do?
Yeah, we could, Lisa. I think Jen and I talked about this a little bit this afternoon. I'm sure she'll add more perspective here in a moment. I think we could, in our framework, if we were to take 2.5%, maybe up to as much as 5%, right? I still think that we would model with our inputs to a number akin to your 6 5/8. Jen's numbers are a little bit different, not as much as we first suspected, and she'll talk to that in a moment. But yes, I think the basic takeaway, and for consideration, maybe not this evening, but at a subsequent meeting, we could, with our framework, dial back the risk just a touch, and I think still be aligned with your actuarial intentions.
At 625 or 6.5?
I'm using in my head 6 5/8 or 6.5, Lisa. 625, like you're right, we would have to, obviously we could come off even more on that, right? We could probably, just looking at these portfolios here, it might be something like 55-45 equity fixed income, right? Maybe a little bit more equity based on how it's configured. The one thing I would offer up as a caveat for folks, and I know everyone appreciates this, this all sounds very impressive and precise, right? And like we know what we're talking about. It's an exercise in false precision, right? We don't know precisely what markets are going to do. We do think with the benefit of long-term horizons, we get pretty darn close, but it's an imperfect exercise, right? So when we're talking about these marginal shifts, a little more conservative, a little more aggressive, what that may do to return, I think we all accept the idea, right, that it's done with the best intentions, but it's not a precise science, right? When we know markets obviously are going to fluctuate and wax and wane through time. So,
and just before we go on, what are you seeing other towns doing? I'm seeing a trend towards 6.25. Glastonbury, West Hartford, Norwich, Ridgefield is thinking of going to 6. Can you tell us what you're seeing and perhaps why they're going that way when it seems like you're not recommending it? And also the time frame you're looking at, 20 years. I think we're at year 16 on our amortization schedule, so it's a slightly different, but we'll get that confirmed by our actuary.
I'm always a little bit careful, right, Lisa, to answer with absolute precision, because everyone's actuarial circumstances are a little bit different. But I think your intuition is spot on. I think the trend statewide is for lower return assumptions. I think that, listen, right, let's shift. Here's the 10-year outlook, right? Here's the first half of that forecast, and look at your mix. That's not 6.9, right? It's 6. Right. So, there are ways to kind of band and frame those expectations depending on your forecast horizon. So I think this journey from the mid 6s statewide for mature portfolios with allocations akin to what the town has is one that's well underway. Like you said, we are seeing 6.25. We work, it's public record, so it's not anything that you can't find on your own. We work with the town of Guilford. Guilford is another Milliman client that we share. Their mix, kind of like you, a little bit more conservative, and they just went to 5.75 on their assumption. So you're absolutely right. The trend is moving down through and into the low 6s, and in isolated cases a little bit beyond that, but. I think you're depending on what the pleasure of the board is ultimately, and when you take your return assumption, we can make marginal changes around the fringe, I think, and still be well supported. Again, with those bands around the different right horizons to get you to if it's 6.25 you decide on, or 6.5 or wherever you end up, right? We'll make a requisite response, but it won't have to be dramatic. It would be marginal, if that makes sense.
Just for the public, if we stay at 6.5 and we come in at 6 in the next 10 years, that's going to raise our annually required contribution. That's where we sort of get into sort of unknown in terms of budget impacts. And by lowering it, we would have more certainty because it'd be less likely we would miss by that much. Is that sort of an accurate way to think about it?
Yeah, I'll defer, Lisa, to Jen on that to an extent, but I think it is.
So I just want to understand, Chris, I may have misunderstood. I'm sort of sensing that you're saying that that you'll sort of try to match your returns to what our, whether we choose to assume a 6.0, a 6.25, a 6.5. I would think you'd want to try to get the best returns you could, regardless of what number we pick. And if you do a great job, then we can all say hurrah, and we've got, extra money in there, which is a good thing. But am I misunderstanding that you're going to? I don't think you're right. We want to be fair and honest and transparent, right, about the return potential on a go forward basis. Let's go back just, and I'm trying to remember, I know there's some historians on the board, right? And we've been around a while as well, but look at the 10-year number for the pension plans, right? 8.7% to your point of excess return. 10 years ago, what was, Lisa, you're the best historian, what was our assumed return, right? Was it 7.75 then? Or
yeah, it was.
So, to your point, Linda, right? There's 100 basis points or thereabouts of excess return. Certainly our drive is to generate the best returns we can. We're beholden to some extent, right, to just the allocation construct. Right?
So that's what I didn't understand. It sounded like you were going to change your allocations depending upon what our assumption was. And I would think those would be two independent things. You want to do your allocate, but I'm not a pension person. What do I know? I would think you'd want your allocations to try to, maximize regardless of what our assumption is. And we'll hope that our assumption is too low and that you'll far outperform us.
Well, Linda, part of it is sort of risk allocation too. Like, how close do you want to get to the, safe rate of return, which is essentially zero right now. But the less volatile your investment mix, that can sort of stabilize the fund over time. That's one of the goals. And because we're dealing with other people's money, although we can tax for it, I think there is a leaning towards being a little bit conservative with how we invest it, and we're required by law to be some degree of conservative. So, but you're right, it's the cart horse thing, which comes first, the allocation or the assumption.
Right. Well, and particularly looking forward to the next few years when we, have a bit of a capital crunch and we know we're not looking at big increases in our, underlying tax base, that, I'd rather err on the side of overperforming than underperforming, because otherwise we're going to be in a much bigger problem in a couple of years.
No, I think that's.
If you could explain skewness and kurtosis.
Yeah, so really what that's a great question, Art, but skewness and kurtosis, right? There's this basic kind of acceptance in capital market theory that return distributions for asset classes, you kind of start with the assumption that there's normal distribution, right? We know that, in fact, statistically, that's actually not the case. It's a necessary constraint to kind of begin the optimization exercise. But we know that portfolios and return streams have, quote unquote, fat tails and can persist down in stress markets and have periods of outperformance versus normally distributed return stream. And those are just statistical ways that we're trying to capture some of that tendency behind the scenes when we're building out the optimal portfolios. Great question, and it's but a nuanced one and a good observation. But that's essentially what we're doing with some of those statistics. It's a second order statistical considerations as we're building out and optimizing the portfolios.
I guess I got that in theory. What are you trying to do? Make it more realistic?
Exactly. Yep. It's just additional data points for us, right, to kind of understand some of these tendencies under the hood that don't align precisely with some of the statistical construct that you need from a theoretical standpoint to begin the exercise. Boy, that's a mouthful, isn't it? But that's that's essentially what it is. So yes, you're exactly right. The practical and the better explanation is it's a way for us to kind of introduce real world tendencies into the mix when we're doing the modeling.
Thank you.
So I don't know, Lisa, if it makes sense with this exhibit up, or if to transition to Jen and for her input on.
I think so.
Return assumption, and then I know Tyler has a little bit of an update on the defined contribution areas.
Perfect.
So do you want me, Jen, to stop sharing this? I didn't know if you had collateral or not to share.
No, you can keep sharing that.
Okay.
Thank you, Chris. Thank you, Lisa. So Chris was kind enough to share his analysis with me ahead of this meeting so that I could take it into consideration as I performed my own independent analysis. The last update you got from me with respect to the interest rate assumption was a year ago, and it was based off of so Milliman also develops its own capital market assumptions twice a year. We do it independently, and we typically come up with assumptions that are often in line with fiducian's assumptions as well. So I took, as part of the exercise, I noticed one key factor. Is that the target allocations that we have been using that we are aware of were not quite in line with some of the more recent tweaks you've made to your allocations over the last year or two. So we incorporated those asset allocation changes into our analysis along with our updated capital market assumptions. And the resulting return assumption that we came up with was about 6.7% long term. And that compares to Chris's 6.9% assumption. So a slight deviation, but in the ballpark. As you compare it to your current interest rate assumption of 6.625%, you're right on target. So what that tells me is that assumption is good and sound to move forward.
Wait, can I just intervene? You said 625. Our current assumption is
6.625.
got it. Okay.
So it's good. It's a sound assumption based on our most recent analysis. The outlook for capital markets is definitely more optimistic than it was a year ago. What we don't know is if that is going to be long-term in nature, or if it's more of a fleeting outlook. Only time will tell. Now, looking at the projections and the estimates we've put together for you thus far, if you were to remain at the 6.625 assumption this year, reflecting large asset gains during fiscal year 21 that the plans enjoyed, you're looking at reduced actuarial determined contributions across all three plans. Now would be a good opportunity to consider reduce, still, even though the analysis supports the 6.625, is to maybe be a little bit more conservative, consider lowering the assumption, not necessarily all the way down to 6.25, but maybe 6.5, because we don't know long term if this is a fleeting optimistic outlook or if it will persist indefinitely. But you're at a point where you can take advantage of those gains to still lower the assumption a bit and still reduce your actuarially determined contribution from last year. We don't know what this year is going to bring. Chris mentioned thus far you're at about 4% return. We want to be able to withstand any upward pressures next year as well. So something to consider. I would support either assumption, either 6.625 or 6.5. I'm an actuary. I'm a conservative in nature, so I'll never not support a conservative assumption. So at this point, I'm open it up to any comments or questions, or if anyone would like me to elaborate on anything else.
Open it up to board members first. Are there any questions from board members?
Well, just to go back to Lisa's earlier question, can you speculate about why other towns are going to 6.0 and 5.9 if it's okay for us to stay at 6.5?
Well, the return assumption is a function of what your asset allocation is. So some town, a town that's going to 6% might be a little bit more conservatively invested than you are. It is, it's a function of that allocation and the risk appetite of the town. You could be, so that's primarily why.
Do you see our risk appetite as leading to higher volatility in our ARCs compared to some of the more conservative allocated? I had asked Amy, and Amy just always does great work and pulled together our ARC contributions over the last decade. And where we run into sort of but heart palpitations is during the budget process when you have a bad year and all of a sudden you have a huge increase. We're particularly worried about next year because our debt service is going to go up. Mm-hmm. So we don't want any volatility next year. So can you just talk about that in relation to the assumption, how that impacts our decision making? Right. So something to consider to kind of address that, this is a strategy, is to keep the return assumption at the 6.625, which does in turn produce a lower actuarially determined contribution. But just because that's what the actuarially determined contribution is, doesn't mean that you have to put in that, you have to actually contribute that amount. Maybe you contribute an amount that's a little slightly higher so that next year, it builds in that conservatism so that next year, if there's a spike in the pension contribution, your actual contribution might remain kind of level and then take away that volatility. That's a strategy that we've been talking with a lot of our clients about recently this year, especially this year, because most of our clients are sitting on 25, 30% investment returns for fiscal year 21. So we're trying to be strategic about how to put that to work rather than just taking a contribution reduction.
If I understand, Jen, what you said is you assume a lower number than you provide for. Is that accurate?
No. We would assume the 6 5/8 that you're currently you're currently at, which is supported by the analysis. And me just for going off of my estimates that I prepared earlier, late last year, for example, the government plan, based on just updating reflecting the strong asset performance, the contribution went from 1.4 million down to just about 1.3 million. So a savings of about $100,000. My recommendation is to maybe still put in $1.4 million this year, even though my calculation, my report will say put in 1.3, put in more. Next year, that 1.3 might grow to 1.35. You put in 1.4 last year, so you've built in that cushion so that if there is a steep increase in the actual results, your contribution's not actually going up.
So contribute at a higher rate than your assumption.
Yes.
And we could do that even if we went at 6.5.
You could do that at 6. Yeah, you could do that at any interest rate assumption. At 6.5, you're likely still going to have a lower contribution than last fiscal year.
Very interesting. Amy, I don't know if you can share your screen and do the ARC history over the last 10 years. When we do our long-term planning, Jen, one of the things that's sort of striking is that the pension costs are going up about 8% a year, where everything else is going up in the 2s, a few 3s. So it's something that weighs on us, and we're trying to manage the variance and how do we plan for that and predict for it and get to a more stable.
I'm sorry, Lisa. Before we get to that, I'd like to ask a question about the matter we were just discussing. I understand how we can arrive at the same result in two different ways in terms of conservative planning, either by lowering the assumption or by making contributions as if we had lowered the assumption. But what I'd like you to speak to, and maybe you can't answer it, is what are the relative advantages of each approach? What reason would we have to prefer one over another?
Well, to keep the interest rate assumption where it is and contribute in excess of what that assumption would result in gives you flexibility that you haven't locked in a lower assumption that's going to drive a liability higher for next year. So it gives you some extra cushion there to reduce the interest rate assumption to, if you say reduce it to 6.5% this year, it would be hard to support increasing it again next year. Even if the analysis necessary, it just might raise questions. So it's better to keep the assumption where it is because it's a sound assumption that is very supportable, and maybe just consider contributing in excess. There's also other things we could look at to take advantage of the gains that the plans have benefited from over the last fiscal year, and it kind of addresses the growth in the contribution that you've seen over the last 10 years or so at roughly 8%. The contribution is designed. There's two components to the contribution. There's the normal cost, which is the value of benefits that are being earned. That's usually fairly steady year over year. And then there's the amortization of the unfunded liability. We extended the amortization period a bit last year to help address that. But another component of that calculation of that amortization is the amortization growth rate. And that's currently 3.5%. So all things being equal, that payment is expected to grow by 3.5% per year. We could take advantage of the gains this year and maybe look at lowering that amortization growth rate, which would build in a lower growth into your contributions year over year. You could go all the way down to zero where it's level dollar. What a level dollar amortization is you're going to pay more now, but you're going to pay less later on because, all things being equal, you have to pay down that unfunded liability. It's just the incidence of when you make those payments and how much. So it's another thing we can look at as we put together the numbers this year.
Okay. And are we on year 16 of our amortization?
Yes.
Schedule? Okay. So this is a pretty big shift from year to year. And I think, one of the things we struggle with it, when do we get the information so that we can make the right decisions. We can only base our decision making as the policy board on the information we have at the time we have it. As you mentioned, it's a year old by the time we're considering it this year. Mm-hmm. So I'd look to you and to Amy and Maria as how can we get better information timely for the budget process? What are your thoughts there? I mean, maybe there's nothing we can do, but should we just bring you in every year? I mean, what should we do?
I mean, so, you know, I do this analysis as part of my process every single year. I haven't done it until now because we haven't gotten started on the valuations yet this year. But I'm happy to do it sooner if you want to bring me in sooner and give you the information. We always provide estimates based on last year's information projected forward, but we can certainly do that earlier if that's helpful for the board.
It would be. And also, thank you for this explanation. That was really helpful. And I'm really glad we brought you in this year because we might have, the information we had may have walked in a different direction. But I am interested in some of the ideas you put forward. And I'm going to turn to Amy as to how Amy thinks we should best evaluate those and what the process would be to do some of the considerations that Jen mentioned.
Can I ask a question? Can people hear me? How well funded are the pensions? Like, what are we seeing a growing unfunded liability, or where do we kind of stand? Because naturally, the lowering the expectation, the discount rate on the unfundeds will ultimately improve the funded rate. So I'm just curious as to where we are now on the town budget.
Yeah,
I'm sorry, town pension plan.
There's three different plans, and the town and the Board of Ed plans are about 70% funded as of July 1st, 2021, and the police plan is about 80%. Those are all up from last year, primarily due to the strong investment returns in fiscal year 21. If we were to lower the interest rate assumption, that would bring that down a bit again, because of course the liability would increase.
Right. If you were to bring it down, it would increase, right? Because the expected rate is down. Understood. Yep. And how does that compare to, let's say, a town that's used, our peers, for example, who may have, discount rates that are lower than ours? Do we have any sense of our peer set and their funded status?
I think you're pretty much in line with many of your peers. If nothing else, you might be ahead of some of them at the 6 5/8 assumption. The town of Farmington, just right next door, is at just lowered to 6.75 this past year.
Oh wow!
So you're making good ground there.
Do you think we should be moving to a lower number or no?
No, the analysis supports staying where you're at. Moving to a lower number is just an extra layer of conservatism that would potentially build in maybe additional investment gains in the future. But again, you move now, then it's hard to support kind of bouncing back up next year if the market's the optimistic look persists.
The only observation I would have is that, over the last few years, we've been talking about targeting a 6.25 to maybe 6.5. And so this is kind of the first time that we're discussing kind of holding steady at our current rate. So, given all the headwinds, I'll call them, just capital markets, geopolitical, whatever, does it, this is 1 year versus our history 4 or 5 years, at least in my experience, that we're now talking about holding steady instead of lowering. So I'm just like, instead of going all the way, my line of thinking is, well, instead of going all the way to 6.25, maybe we, split the difference and end up at 6.5 as opposed to taking it all the way down. Just kind of trying to balance the information over the last few years versus what I'm hearing now. Does that make sense? Because what I wouldn't want is next year to come back and say, well, you really should have been on track to lower it to 6.25.
Right. And the target is a moving target. And as Chris alluded to, it's an imperfect calculation. And we could come back next year and say that it should be lower than you're at, or we could say the opposite. We don't know. So you could build some conservatism and make a small move this year. It still leaves you with most of the plans to maybe do some other things. We haven't analyzed the updated census information yet. There could be gains on the liability side that helped as well. There could also be losses on the liability side that would kind of offset some of the investment gains. We just don't know that yet until we've had a chance to go through all that information. But we could do some combination thereof. A small decrease in the interest rate assumption to say 6.5. Look at the amortization growth rate, maybe reduce it from 3.5 to 3, chip away at that a bit. There's, a variety of things we could do. But I think anything that you do, I would recommend the end result being an actuarially determined contribution that is at least level to what the prior year's was, and rather than taking a holiday on that.
No, of course.
Yeah, understood. Thank you, Jen. Thanks.
I agree with Derek in particularly knowing that, if the future is unpredictable, and yes, you're right, we could be faced with, let's raise the expectation next year, and that's not the worst case scenario to me. The worst case scenario is, oh my gosh, we should have lowered it, because next year it's not going to be so easy. This year it's easier. If we're going to lower it at all, it should be this year, because this is the year we can afford to. So I support what Derek's point was.
Jen, one of the things we're considering, as you know, tonight is the experience study, and that again may change some of your recommendations depending on the result of that. So can you give us some insight there and sort of the timing of how we should think about this?
Right. So the experience, if you decide to move forward with the experience study, we would look over the last 5-year period. Any recommended changes we would not reflect until the 2022 valuation, which would be for your fiscal year 24 budget. But there's a possibility that those potential recommendations could also increase the actuarially determined contribution. So you got to, again, think strategically. Do you kind of pocket some of the savings you have a little bit and not make too many changes to assumptions now so that you can potentially withstand that? We're also going to revisit the interest rate assumption as part of that study again when we do that. So, but in my experience, it tends to increase liabilities more than it decreases liabilities, these studies. But we just don't know until we've measured the experience.
And it is still the Government Financial Officers Association recommendation to do these every 5 years, is that?
Yes.
And we are certainly due for it. It's been 10. Okay, so I just wanted to, so Amy, could you weigh in here on your thoughts? What are you thinking? Because we're hearing a lot of new information, and I'd be very interested in what our Director of Finance thinks on this, and you can give us some guidance on timing and things we should think about, and any leanings you have at this point.
So overall, the philosophy has always been to go with what the actuary recommends. That's something that I'm comfortable with. It's something that we have a long-term plan for with the amortization schedule to get to our goal. I see this year that we're potentially going to have a good year. So if we did want to lower it, I would be comfortable with going to the 6.5. I think it's more of a board discussion on going any lower than that, because going lower to the 6.25, there actually is an increase in cost to the taxpayers. And there's been some pushback by the board prior of taxing unnecessarily, even if it's for a savings down the road. So I would be comfortable at the 6.5. I think it gives us a little bit of savings for this year. I think it gives us some cushion for going forward. That's probably my off the cuff thoughts. After I've had time to digest it, I might rethink it, but just based on what I'm hearing, those are my initial thoughts.
Okay, that makes sense. And Amy, we haven't gotten to your report, but we are looking at some excess revenues in the current year budget and some excess savings. So when we get to the budget, your budget discussion on that, those may be things to think about, making the excess contribution per Jen's recommendation to offset any volatility in the future. Does that make sense, Jen? That's kind of what you were thinking?
Yes.
And what amount were you thinking, Jen?
As much as you can withstand.
Would you say like anywhere from 100 to $1 million, or?
I mean, I think it's not a bad idea to, in addition to looking at the interest rate assumption, to look at the amortization growth rate and see what that changing that a bit will produce an extra contribution, and maybe using that as a guide to help kind of get that contribution up. But I think you really you want to stay at least level with last year. Maybe even if you used to 2% increase everywhere else, maybe you increased last year's by 2% or have you. But it's really, it's a balance between your budget and other factors. So
could you work with Amy on that?
Yeah.
Come up with a recommendation, Amy, in terms of what that would do with the amortization period increases over that time, whether we can get that down depending on what the contribution is, and make a recommended to our board as to what you think it should be.
Yep, I can do that.
Thank you. Maria, did you want to chime in on any of this?
No, I would just really concur with what Amy said. Sorry, I'm just needing to switch over to video. There we go. Yeah, I would just concur with what Amy said. Based on what we're hearing and seeing, I think 6.5 is probably a good place for us to be for the upcoming fiscal year.
So I'm hearing consensus on that. And then we'll look with Amy, will work with Jen as to whether we do with some of the excess revenue or budgetary savings, whether we do an additional contribution at year end or during the budget process, and what that might do to the further, how that might help us in the out years. So we'll do that analysis. Are people comfortable with sort of that approach on the Board of Finance members? I'll open it up to Wendy and Susan. I know it's going to come to you through recommendation of your retirement committee at some point, but if you just had any thoughts, I wanted to give you the opportunity to chime in as well.
I'm comfortable with it.
Okay, so we have our sort of working orders. We won't make any decision tonight. Amy, does it make sense to do this during the budget process? We'll sort of plan. We've been planning on 6.5, but we'll actually take the vote as we get closer.
Yeah, that's fine.
Okay. Does anyone have any other questions for Jen? Jen, first of all, thank you. That was really, really helpful. And we'll let you work with Amy and so that we can get you in during the budget process. We found that was just great. So thank you.
Welcome.
Okay.
Just, one last question. I'm sorry, before we leave. I think I heard you say that what you're recommending is that in terms of the amount of the additional contribution to the plan, is that we contribute at least as much as we did last year. Was that right?
Yes.
Thanks.
And Amy, how much would that add to the budget as it stands now with the estimates? Not that much, right?
Yeah, I don't know offhand. I'd have to pull it up.
Okay. Well, we don't have to decide that tonight, but that would be a good number to get because we could either do it during the budget or at year-end savings. Does it have to be done during the budget?
No, we can wait until year end if you're thinking of using year end savings and allocate it then, which would probably be the preferred method so that we don't count our chickens before they hatch.
Okay. And that's usually in October, right? Okay. All right. Good to think about. Oh, Derek, go ahead. Oh, you're on mute, Derek.
Are we deciding on the experiential study? I don't want to get ahead here, but is that something the board would like to take action on tonight?
So Amy, I posed that to you. I wasn't sure how we should do that. Should we do that during the budget process, or should we do it now? Is it a supplemental appropriation, or is it just an administrative move on the funds? Jen, as we understand from Amy, it's typical to use the funds themselves to pay for the experience study. That's part of the administrative costs of so I don't know that it's a supplemental appropriation, but if it is, we do need to go to the Board of Selectmen. So can you let us know what process we should use to do this?
Sure. So it's not a supplemental appropriation. There's administrative expenditures that come out of this fund on a regular basis. Those looking for estimates for retirement, all of the work that Jen does for us, probably this meeting tonight. So there's expenditures regularly coming out of this fund. There's certainly enough money in this fund to cover it. So if you all wanted to move forward with it, basically all you have to say is we want to move forward with it, and Jen can make it happen.
Just for the record, Jen, can you go through the costs for us?
Yep. Let me pull up my statement of work.
While Jen is doing that, just for the public and for invited guests, the retirement subcommittee did recommend we go forward with this using the funds themselves, as is industry standard.
So yes, it would be a fixed fee, and we would perform the analysis separately for each of the 3 pension plans, and the fee would be $13,000 per plan to perform this analysis. And we'd look at a 5-year history of experience and compare the plan's actual experience to our actuarial assumptions, and look for trends or deviations therein, and make recommendations to change assumptions going forward to result in a better estimate of the plan's liability.
And Jen, just so that folks know, are the funds altogether, what is the total amount of the 3 funds? It's about 90 or something. I don't even.
Roughly. Yeah, probably about 90 or so, 85, 90.
So when you think about 36,000, that's sort of a very small amount, and it's recommended by the Government Financial Officers Association. So an industry best practice. So Maria, did you want to speak to that before we go ahead and vote?
I'm very comfortable proceeding with that, Lisa.
Okay. All right. So Derek, why don't you go ahead and make a motion then?
Sure. I'll move that we utilize pension fund dollars to go forward with the experiential study for $13,000 per plan.
Okay. Is there a second?
I'll
second the motion.
I'll go with Art on the second. Any further discussion? All in favor, please say aye.
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 Okay. Thank you, Derek, for that reminder. And I think, Tyler, you're up.
I'll just go through the numbers and get you off to the next agenda item. But I'm going to go through the defined contribution plan. Just a reminder, the DC plans with Mission Square used to be with Hartford, then Mass Mutual, then ultimately it was going to go to Empower. But can everyone see the screen here? The numbers of the 457 plan.
Mm-hmm. Yeah.
Great. So up from about 14.6 million to about 16.4 as of the end of the year. You can see bulk of the assets mixed between the Vantage Trust Plus Fund, which would be their stable value option, the Fidelity Index Fund, and then obviously target date funds. Just a reminder, how we built this out is the 3 ways of investing, really. The active management, of which we have 7 individual active managers. The index funds, of which we have 10 all through Fidelity, and then the target date funds, again, sort of a one-stop shop of a mix of equities and fixed income based on folks' retirement date. You can also see the 401A plan and its growth, as well as the Board Ed 401A plan. Performance starts on page 16. It looks a little bit different than what you saw with Chris's deck, but as you can see, it's performance net of fees on a quarter, 1, and an annualized on a 3, 5, and 10 year. Then, of course, the expense ratio, and then we have our internal status with our manager research team, anywhere from maintain, which is obviously we're comfortable with the manager. Discuss could be something that we're a bit concerned with. Maybe it's a retirement of a portfolio manager. Watch is often a combination of organizational change and performance concerns, and then of course terminate, where we'd want to replace it with an alternative option. So what you'll see here is you also see the index. It compares itself to the median of the peers, and then the peer ranking, 1 being the best, 100 being the worst in that category. And so what you'll see with the target date funds is they've performed fairly well long term. A little noise on the quarterly performance, just given T. Rowe Price was a little bit more biased on the value side and a sort of growth equity outperformance in the quarter. But the longer term, some robust numbers over the index as well as over median and then top decile versus peers. All of this, of course, net of fees. When we look at the core menu, again, you can see the performance of the index funds as well as the active managers. Western Asset, Core Plus Bond Seek perform fairly well longer term. No big concerns there. There's some noise. T. Rowe Price growth stock, just some underweight. Some of the technology names that are weighing on performance on the quarter and 1 year, but longer term, we're still top quartile. And no big concerns there. And so, again, all funds are on maintain. We don't have any recommendations to change the portfolio as it stands now. And I'll pause there to see if there's any questions from the group.
Open it up to board members. Anyone else have questions? Okay.
Great. That's all I had.
Tyler, just one quick question. We have to update our policy, our investment policy, I think, with you, correct?
I think, and Amy, correct me wrong, that it was done a year or so ago.
Yeah, that's correct. I sent Tyler the updated document. You all did it May of last year.
Ah, perfect. Okay. So that's already been done.
Yep.
Okay. That was the only other question I had. Thank you. Does anyone else have any questions for Tyler?
Just generally, Lisa, we talked about kind of manipulating the allocation a little bit. I don't want that to get lost month over month because I think it's an important discussion. So I know we might have some recommendations coming to us, but I would be in support of taking action at some point, either voting on or taking some action to reallocate some of those funds, just given the strength of the capital markets over the last 3 years at minimum, and taking maybe a few chips off the table, I guess is a way to put it, in light of our further reduction of the unfunded liability discount rate as well. So it's just wanted to make that statement.
No, thank you. I think that's a good plan. We'll look forward to the recommendation.
Okay.
All right. Is there anything else anyone wants to add at this point? Okay. We will now move on to the budget, discussing the budget. Thank you, Tyler. We really appreciate you coming out.
Thanks, everyone.
First of all, as Amy pulls up the budget modeling worksheet, I wanted to thank everyone who's working on the budget, and mention that Wendy and I had an opportunity to attend the Board of Education's budget workshop. It was really well done, and I appreciate all the presentations and the work that must have gone into that. And I know Maria and her team is working hard on the Board of Selectmen and looking forward to that. Special thanks to Amy, who is just putting in so many hours and doing such a great job. Very appreciative to that. I think one of the challenges the three boards have had over the years is how do we do a budget and give guidance and deal with such uncertainty with the schedule that we've got. It's always a challenge. We have to follow the charter, but we end up starting a budget without knowing what our revenue is. And if you did that in a business or a family, people would think you were nuts. That's a strange way to budget. Obviously, if revenues are flush, you do one kind of budget. If revenues are super tight, you do a different kind of budget. And we start the budget process without knowing any of this. And our projections have been, appreciate all the effort that goes into making the projections, but they've been in part because of the pandemic and lack of resources on the town side. We don't have good projections with which we can base. And so that's the perennial problem, is how do we move to a good budget process given the constraints of when we get the resources we need to do a true evaluation. But one of the things the three boards we all committed to is sort of sharing information as it comes in. And we have some new information that we didn't have during the tri-board. And I'll just go through that very quickly and then ask Susan and Maria if they have any other information they want to share. But at the tri-board, when we met initially, we thought the grand list was going to grow at about 0.25% or about $250,000, which is essentially zero on a $100 million budget. And it turns out that our grand list really came in quite a bit higher, with an additional 3.5, almost $3.6 million. So it's a dramatic change from December when we were initially looking. The other thing that changed in December when we were thinking about the American Rescue Plan Act funds, at that time we thought it was very limited use because we didn't qualify for lost revenue, which enables towns to use government services, which is the broadest use of that money. We didn't think we qualified. The final rule has since been passed in January, and now we do qualify for revenue loss and now can really use the full $7.5 million for government services. So essentially, and I'm going to say it wrong, and Bert, you're going to have to correct me on the quote, but we went from water everywhere, not a drop to drink on ARPA, to drinking from a fire hose. So dramatic change in those two numbers. The other thing we're looking at, and we'll get to that with Amy, is some year-end savings. We're projecting reserves at 18%, and our range is 15 to 17%. And our policies, one of the things our policies say, once you get over 17%, is to do with the excess reserves, is to contribute to the pensions. And having heard from Jen, that will probably be a topic of conversation coming up. The other thing that has changed since December is inflation is proving less than transitory. It's now, the latest numbers came in CPI most recently at 7.5%. And so it looks like it's not just a supply side issue, but we'll be watching that. We've got the governor's run since December, and education cost sharing is up about $466,000 from last year. The governor has proposed a motor vehicle mill rate cap at 29 mills, which would impact Simsbury if that passes. It's too soon to know whether that will happen, and it's too soon to know whether there will be fully reimbursed. I think Maria had mentioned that it's looking like we would come out slightly negative on such an adoption, but at this point, we just don't know. We'll be monitoring. So basically, in just 2.5 months, we went from thinking it was going to be a very tough year in terms of revenue to having almost 11 million in usable dollars. So dramatic change. So we did ask Amy to sort of update the numbers as we have them. So putting in Matt's recommendation with the understanding that it has to go through the Board of Education, to put in Maria's initial numbers from December, because that hasn't changed, debt service, ECS, the governor's runs. Amy, can you talk about what other numbers you updated? The 6.5% I think you put in, or you put in 6.25. We can now switch it probably to 6.5.
Yeah, so I originally had put in the 6.25% interest rate assumption. I also did our medical insurance flat, given our healthy reserves in that fund. And Tim Hasselman will be able to talk about our policy coming up on that one. I put in the Board of Ed's proposed budget. As you mentioned, the updated state budget numbers. Francine provided updated grand list projections after her meeting with our planning department. And then I did include median vehicle impact per your request, and then what that vehicle impact would be at 29 mils. And then I did do a rough estimate of if we had our motor vehicles capped at the 29 mils, and then the anticipated revenue coming from the state, what our loss would be. So I think those are all the changes in the budget modeling.
Does anyone have any other changes that we missed? Well, so first of all, thank you, Amy. That's great. Let's get to the thing we're all looking to see. Where does that put us?
So for fiscal year 23, with all of those assumptions updated, it gives us a mill rate of about 37.08.
So that brings us down.
Mm-hmm.
So that's a tax increase. But that doesn't include Maria's increase in her budget. That's the initial. So to come in flat, how much would Maria have if the Board of Ed stays the same?
Actually, I can pull that up. I just did that exercise earlier. Hold on one second. So it would be about $1 million. It puts you a little bit over at 37.46. So probably like a little under $1 million.
And a little under $1 million is what percent for her? It's about 4%.
Yep.
And that doesn't include changing the pension investment assumption to 6.5?
No, that's at the 6.25.
Can you change it to 6.5 now? Is that hard to do? If it is, we can just wait.
Lisa, if we change it to 6.5, we also have to take account of whether we're going to make an additional contribution to the plan notwithstanding the change.
Yes, we could do that, but one of the things we do have capital reserves, and you're right, Bert, but we also have year-end projections. So we have flexibility as to where we take that extra payment. Do we do it in the operating, or do we do it with dollars we have?
That brings us to 36.94.
That gives her a little over $1 million increase. So over 4%.
Yep.
So I wanted to open it up to Susan, and obviously we're not going to get into the specifics of either of their budgets because they haven't finished working on them. The Board of Selectmen and Wendy haven't even started there. So I don't want to get into specifics, just sort of thinking broad concepts from Susan and Maria. Is there anything we need to be thinking about, or is there new information that we're not aware of, or that you want to share, or that you're worried about?
For us at this point, Lisa, we're going to vote on our budget Tuesday, the 23rd. So we're pretty confident with the numbers that we're looking at. We're not expecting anything to really change between now and then.
Thank you. I mean, I do want to just mention for the public, I'm sorry that wasn't taped. It was a wonderful presentation. It was hours long. It was very detailed, very methodical, data-driven. You could really see the rationale behind the recommendations. So I do want to acknowledge all the work that went into that, and actually the great questions by your board.
I'm really glad that you got to see that in action. You know, it's always my favorite meeting of every year because we really get into the nitty-gritty of everything, and I think people don't always realize that.
Yeah, it was great, other than the heat wasn't on because it was the weekend.
Yeah, well, there is always that.
Maria, did you have anything that's new or that you're worried about or that our board should be aware of?
Yeah, so a trend that we are seeing, particularly in regards to capital, is the impact of COVID inflation. I know that Amy has spoken about that previously in some of her finance director reports to you. But, numbers that we had even last year are no longer, always good numbers in some of our capital budgeting. So there definitely, will be some changes there that you'll see in some existing projects that were on the plan or purchases. One example, our fleet purchases, we're seeing in some cases about 5% increases. And it's also just a lot harder to get vehicles. So we might order it and then it might take 6 or 9 months to get here too. So we're also seeing delays in terms of when we're actually able to receive the equipment. We're also another area where we're seeing that as for example, is playground equipment. So last year during budget, we had a really good estimate to redo the Simsbury Farms playscape. It was $200,000. That is in our current capital plan. But just since last budget, season, it's now gone up to about $275,000 to do that project. So there's a huge demand for playground equipment. And again, that's just an example of another area where we're seeing some pretty significant price escalations. And then depending on the industry and type of project, labor costs have increased, other supplies, materials. So again, I think on our capital budgeting, you just, can anticipate seeing some of those project estimates might look, a little different this year. We're also seeing on the operating budget side, agricultural supplies is another area where COVID inflation seems to be impacting us, things like grass seed and things of that nature. So much smaller dollars, but an area where we're seeing, again, sort of a higher, percentage increase. And then the number of our computer software programs that we use, just sort of across the board, that's another area where we're seeing some 3 to 5% increases, where in past years, things were flat or maybe less than 3%. So again, I think those are probably some of the main areas that we're seeing sort of the impacts of the COVID inflation that are probably a little different than what we talked about during Tri-Board.
Yeah. Maria, are you sort of planning for those to be transitory? Some of those are supply, and some people are saying those will come down over time, or do you see those as they had the opportunity to raise the price and they're going to keep it?
No, it's so hard to know. We've talked about that a bit at a staff level, and I just don't think we have a good answer for that yet.
Okay, so
I have a question about that, Lisa, as well. I mean, it's not just a matter of increase in costs and wages, as you mentioned. Prices will go up faster than wages. But I would say, I think the board should contemplate availability, shortages of materials or whatever the examples that, for playgrounds, et cetera, or for vehicles. If we're looking at having to wait 9 months to receive goods that we're budgeting for now for the next fiscal year, does it make sense to actually purchase those things out of this year's budget when we're not going to get the benefit of potentially new technology and new ways of doing things, as well as potentially just lower costs? It's just something that I think we should think about in terms of what we're paying for now and when we actually get to use it. So that would just be my 2 cents.
Thanks, Derek. I know you've been a great champion of raising this issue and appreciate it. And you're right, between what you and Maria have said, it's going to be a challenge. Before we move on, Wendy, is there anything you wanted to share before we continue this discussion?
I'm very happy to hear the 6.5. It just makes everybody's life easy going into our budget. And, we're still waiting for Maria's budget. Just one of the outstanding questions is the request for 6 police officers to the Board of Selectmen. There obviously no decisions have been made, but that is out there. And then as far as the ARPA funds go, I know some of that could be used for some services, like Board of Ed is, recommending, or Maria's recommending that we use it for 2 social workers, right? As long as there's no cliff. And I believe Maria's also thinking of that. So that can accommodate some of what's in the budget for us going forward. And I think using the ARPA money for other needs that we can pay for now, I think we're in a good position.
Okay, thank you.
And just to reassure everybody, we've worked with Amy to make sure that we're not going to have a cliff with the social workers. We are very mindful of how to use that money to the advantage of our students.
Thank you.
That's what we heard.
For the public, what a cliff is, when we talk about a fiscal cliff, for those who might be watching, if there is anyone watching, it's just ARPA money is one-time revenue. So you try not to use it for ongoing operating, because at some point that revenue disappears. And then what do? You're stuck with a position and no way to fund it. And that's what we mean when we say fiscal cliffs. But do appreciate, we did hear a lengthy discussion on how to deal with the fiscal cliff at the Board of Ed meeting. And I'm sure Wendy and Maria will similarly have an approach on that as well. But Amy, could you sort of walk us through going back to the Excel spreadsheet, and you'll sort of see that the mill rate actually goes down in the out years, and that's because of revaluation. Can you speak to sort of what's happening in the G column?
Yeah, sure. So like Lisa just said, the mill rate is going down, but if you take a look at the $350,000 home impact, their taxes are actually going up, because the reval, we're anticipating that there's going to be about a 20-25% increase in somebody's home value. So their home value is no longer $350,000. So although we are showing a decreased mill rate, there are some homes that will be impacted and actually have an increase in the amount of taxes. And then the other item down here that Lisa had me add that I just wanted to touch on quick is the vehicle impact. So the median vehicle assessed value, I think, was about $11,000 or something like that. So a value vehicle at $17,000. We have, this is for 2 vehicles. It's about $800 per household, if you will, assuming a household has a minimum of 2 vehicles. And then down here, we have the mill rate impact if we are capped at the 29 mills for vehicles. And then the vehicle impact is about $690. And as you can see, that stays the same from year to year, as our mill rate is higher than that, and we'd be capped at the 29. And then lastly, down here, I have the motor vehicles calculated at the current proposed mill rate based on this budget modeling. And then we have the motor vehicles capped at the 29 mills. And then the variance here is about $2 million. The state is proposing giving us slightly over $2 million. So it'd be a deficit to the town of about $168,000. So as you can see, the state in turn is not making us whole.
So they haven't passed the bill yet, but yeah, the governor's proposal is correct. So we don't have a sense yet whether that's going to go anywhere. That will be a benefit, though, to our residents in terms of paying less in car tax, with although not made whole, the 168 won't really change their taxes that much, but it could be a benefit to them on car taxes. So we'll be watching that. Is there, I know you did some other projections. Is there anything else in there you wanted to share with us on the numbers that you've added?
I think it would just be on the pension information. I did the pension impact. So if we did, these are the 4 scenarios that Janet Milliman gives us gives us each year that we ask for what scenarios we plan to work with. So each of our plans, if we had no change in assumptions, this would be our net budget change. If we just changed our asset performance, this would be our budget change. If we had our interest rate at the 6.5 that's being discussed, that would be our budget change. And then our interest rate at the 6.25, that would be our budget change. So if you go all the way down here, you can see that the each year is, or each scenario, I should say, is a budgetary decrease until we get to the 6.25%. And then based on these numbers, it translates to a 0.03 mill rate increase or $8 per person. So just know that that analysis is out there as well.
So Amy, if we did what Jen suggested and kept it flat, it would be an additional $300,000 for the pensions?
It would decrease 300,000.
But she said to pay it as if it didn't decrease.
Oh, so if we kept it flat, so I mean, it would be a zero impact.
But we're having a decrease, so shouldn't we? I mean, she suggested we pay more.
Right. So are you asking
from where we are on the original chart on the mill rate projections?
Oh, what happens to the mill rate?
Yeah.
Oh, I don't know. So if I just matched last year's budget numbers. Of course, I don't remember what it was before, but 36.93.
So that's still coming in with a tax decrease. So that's one thing to think about. I'd ask Amy and Maria and the Board of Selectmen to sort of evaluate how to incorporate some of Jen's suggestions about prepaying some of the, whether to do it as part of the operating budget or to do it from reserves or from end of year savings, just to give that some thought during your budget process would be helpful. Can we take a quick look at the debt service projections?
Sure. You want the dollar values or the chart?
Dollar values first, please.
Yes. Are these line items highlighted in gray?
Right. And so you're certain.
Yep, go ahead.
For this year, we're going to be a slight decrease from the prior year, right?
Yes.
But it's next year. Look at that big jump. It's over like $1.5 million increase. And then the year after that, it's an $800,000 increase. And then the year after that, $600,000 increase. So as we look at that, I think we can all sort of see next year is going to be a tough year. $1.5 million is just going to debt. And right now, the Board of Education's whole budget increase is about $2.5 million. So in terms of proportionate challenges, that's going to be a big challenge next year unless Grand List comes roaring back, and for the next 3 years. So I guess one other thing, for the three boards to think about and falls most heavily on Amy is how do we plan for this increase and how do we make it more palatable to the residents over time as we're watching that, because it doesn't really start going down until fiscal year 27. And that's going to be a little bit of a rough haul there, 26 and 27. So I just want to raise that as an alert, and for all of us to sort of give some thought to is how are we going to deal with that in the budget.
Lisa, can I ask you a question on that?
Yeah.
So I know the debt service hits in 2 years, right? If what we spend this year, right, hits in a future year.
Yeah, more or less.
More or less. So you could have to talk a little simplistically. I'm not a budget geek here. But we do have room to use some of the ARPA funds for some of these potential projects that are in these out years that may end up lowering the debt service in those future years. Is that true? I could ask that of Amy too, or Maria. depending on what's on the CIP this year and what we're planning in the next year. If it falls under the $1 million.
Yeah. You want to go to the graph and sort of show that?
So this is the graph of all of our anticipated bonded debt. So we don't have a revised capital improvement plan. So just want to put it for transparency that this is the plan that we are currently under. This is not a projected plan from the superintendent and the town manager's updated budgets for 23. So based on this plan, these are all of the projects being anticipated. And this is our financing associated with them and when we're going to see the debt hit. So for fiscal year 23, we would do our issuance, and this would be for all fiscal year 22 and fiscal year 23 projects. So we have not approved fiscal year 23, so this is an estimate. But if all of the projects are approved, we would do a debt issuance of about $10 million. And then our first debt payment would be in fiscal year 24. So all of this information gets translated into this graph. And, oh, I made it too big. And you can kind of see here that each color is basically another layer of debt. So starting with the black, this is all of our existing debt. And then if you go to this green color, this is our 23 issuance. And then over here, we have the bright pink, and this is our anticipated issuance, our first issuance for the Latimer Lane project. And then we go to this light colored pink. This is our second issuance for the Latimer Lane project as we do it in two tranches. And then for fiscal year 25, we have our blue color here. So you can get a sense for the fiscal 22 to fiscal year 27 plan where our debt is increasing year over year. And then lines that go across are the target debt service lines. So when I first started, there was a target debt service at 6.7%. And then we have our target line at 7%. And then last year, you'll remember that our target line increased to 8% to accommodate the Latimer Lane project. And then just for a visual, we have another target line of 9% and then a last target line of 10%, just as a visual.
And Amy, to Wendy's question, for what they pass in the capital budget for this year, that's the blue
The green.
Issuance?
That's the green.
Green. So,
Yeah.
The green. 23.
So this is Linda. For those of you who are around when the Hartford moved out of town, and we knew that was going to be a big hit to our revenue stream, and I'll probably remember the details of this incorrectly, but we took some money from, I think, reserves because we had some extra, as we do now, and used it somehow, and I'd have to go back and research it, but to sort of set up an expectation of spreading it over a few years to feather in the impact until other things could be built and produce, additional revenue to make up for the loss of the Hartford. Does anyone else remember this?
Yes, I
Yeah.
think we assigned about $1.5 million to be used.
Right. And so I'm thinking
Amy,
we could do something similar.
yeah. Amy, I think we ended up not using it though, right?
Right. You didn't need it.
But you're right, Linda, that is another thing we could think about in terms of the next 3 years that are coming. And that's something that I guess we'd ask Amy and Maria to think about and make a recommendation as to sort of how we're going to manage the 3 years on debt service and whether we should.
Yeah, we had Aspen Green and Dorset Crossing, I believe,
Right.
in front of us at that time as well. So we were projecting some offsets, and I don't know if that's the case here in this situation, but we may have some offsets. I'm not sure. I don't think they're as significant though.
And while, sorry.
Go ahead, Linda.
Just going to say, and while there is that 8% line there, I don't think that we really were thrilled at the notion of making 8% the target so much as a tolerance. But really the target is is 7%.
I agree.
So,
Do we have updated grand list projections from Francine?
Yes, they're already incorporated into the document.
And where are those on that chart? The percentages?
The percentages?
Yeah.
I don't know what you mean.
What are the, I just couldn't see on the chart, the grand list changes, like we're at 3.7% this year. What are they?
Sure. So 3.72 this year. Next year is the reval impact. So that's 14.16%. And then fiscal year 25, 1.47. And then it starts to decline 0.29% and then 0.65%.
Just to remind folks, even though that looks like a big grand list increase, home values will have gone up. So people may be paying quite a bit more in taxes, even though the grand list grew, because we're part of the grand list. So it doesn't reval years are sort of tricky, but you'll sort of see looking out, we had a great grand list projection, this growth this year, next year's reval, and then it looks kind of scary. Hopefully those prove not to be the case. And I think one of the challenges, we've asked Amy to sort of think about, speaking with Francine, very limited staff in that office, what systems are we using? Is there any way to get grand list projections a little bit more accurate so that we can budget a little bit more accurately at the beginning rather than coming in? Because what would have happened, Matt and Susan are at the end of their budget. Thank God the grand list came in as it did. But what if it came in with a negative 372 and they're at the end of their budget? We would all have to regroup, and that's not a good way to spend their time and the town's time. So the challenge we have is, how do we get to a point where we can, as a board, sort of say, this is what our community can afford to pay, but do that without knowing what the revenues are. And that's sort of a long-term discussion I think we have to have, and maybe over the summer. But if folks could give that some thought, I think that's probably our hardest challenge. And, Amy, to evaluate with Francine, is there a new system that would help them? Fiscal impact tools, what staffing, they're manually inputting some of the motor vehicle numbers. That seems crazy in this day and age, but do they need more people to literally help type during the time between December and February? What resources are needed to get more accurate projections, I guess, are things to think about, because I think we'll all benefit from that in the long term if we can get there. And are there different systems? Or I think, Linda talked about what audits should we be doing. A lot of our grand list is predicated on self-reports. What obligation do we have to test some of those periodically? Those are some things to think about. But I wanted to open it up sort of to thoughts, based on what we're seeing here, based on the new information we heard from Maria, from Susan at the close, from Wendy, some of the challenges they're facing, in terms of, it's looking good that we're not going to have a tax increase. I know sort of I'm talking with Wendy and Susan and really everyone, when you're sitting on $11 million in new revenue, it's kind of hard to go to the public and say, let's raise taxes. We should, with all these people, wonderful professional staff and engaged boards, be able to come up with a budget that keeps taxes flat this year. And I know for me, that's something that's changed from now and December. In December, I didn't think there was any way we could do that, because we were looking at no grand list and very limited use of ARPA. And now we can use ARPA and have quite a bit more grand list. So that's kind of one thing that's changed for me in my head. But I wanted to see if other people are thinking that way or have other thoughts or think that isn't manageable.
I just have a couple of thoughts, Lisa. Oh, go ahead. Art. I'll defer to you. I've been talking all night. Go ahead.
You have not, Derek. Go ahead.
I would, I talked a little bit about this with Lisa. You know, what I don't want is that the expectation is we've got $10 to $11 million. We can do whatever we want this year. I actually talked to Lisa about, you know, thinking a little bit forward, you know, and to my comments a little bit earlier with valuations at all-time highs, inflation at the highest it's been in 40 years, costs up, wages up. If we might not want to buy at the top of the market and maybe just say, we've got this 11 million, we don't have to spend it all this year, and have a measured approach about how we want to allocate those such that there may be some cost benefits, let's say, in our next budget process where we can take advantage of lower costs and those dollars will go even further. You know, we will have cost overruns at Latimer Lane. We have more than one public school that needs improvement to it at minimum, if not replacement. So those will be filling those, you know, empty buckets in the out years, Lisa, that we talked about, and really pushing up on that debt service line. So there's plenty of ways to spend the money. I will have, just for the benefit of the group, I'm going to have less probably appetite for anything on the operating side in terms of using ARPA funds for operating expenditures. But you know, capital, I think, is something that I'm more than willing to look at. And you know, to Amy's point earlier, maybe it was Maria, I think we should have, if to the extent we can get it, the timing of whatever we're buying, any capital project, the materials that we're buying in order to effectuate the strategy or effectuate the capital plan, such that, you know, I'll have less, I guess, appetite for those projects that can't get done because we can't get materials until 6-9 months out. So that's a little bit where I'm coming from. I'd like to be, you know, obviously we're stewards of Simsbury's taxpayer dollars on a year-over-year basis. These ARPA funds are taxpayer dollars, and to some extent, Simsbury taxpayer dollars. And I'd like to figure out a way to really have those dollars go as far as possible. And I'm seeing just a tremendous amount of cost pressures and increase in, you know, materials, commodities, wages, such that maybe this year isn't the time to be trying to buy things that are scarce or extremely expensive. So that's just my thoughts on kind of ARPA and the, you know, out years of the budget and how we thoughtfully spend these dollars.
All right. Thanks, Derek.
I'm glad I let him go first. That was well spoken. I just had three big reactions. One was, you know, we got to get this projection better. I mean, suppose it had gone the other way. We end up with more revenues than we thought. Suppose we were looking at a shortfall. Just imagine we had to go back and tell everybody you're going to have to go back and make some cuts, adjust your budget, and so forth. So I mean, lessons should be learned, even though it was good news rather than bad news. Secondly, we're probably not going to see $11 million kind of unexpectedly show up for a long time to come. So if ever there's a year we can come in without a tax increase, this probably ought to be it. And I'm also looking at these increases that we're looking down the road. I mean, we are looking at some rough years to come. So in general, I mean, those are my 3 points that we ought to, I hope we can come through without increasing taxes this year.
Does anyone else have any comments? The only thing I'll add is in terms of Derek's thing, government financial officers does mention that capital projects are particularly well suited for ARPA because one-time revenue source with one-time project source. But the one thing I know that both Maria and Matt are looking at are social workers to address a short-term need of mental health caused by the pandemic. So I don't look at that necessarily as a cliff. It perhaps can turn into one if we can't help people in the time of, but they can spend it through 26 years. But if it is being used to address, and I think Derek had mentioned this to me too, the first priority is obviously taking care of the pandemic. We have to take care of people like that. And to the extent we are using it for people, we recognize that that may create a cliff. And I think both Susan's board, and I know Wendy has mentioned it, and Maria are very conscious of that. And I think that's something all three boards will, evaluate and are worried about and are thinking about. So I think the cliff discussion is super important, but also something I think all three boards are thinking about. And I know Susan mentioned that they're thinking about it. I don't know if Maria, if you want to talk about using ARPA money for positions and any concerns you have with creating future cliffs that you're thinking about, or.
Yeah, so I think we had mentioned this during, tri-board as well, that, one of the areas that we were seeing that the pandemic is now having a really significant impact are on our residents with their mental health and well-being, but on our students as well. And it's really hard to know, with certainty that, once the ARPA dollars expire, we're going to need these people, not need these people. But, I think the thought being is that, as you mentioned, Lisa, we can use these dollars through 2026. And, I think if we, offered positions to social workers potentially to say, hey, we have a 4 to 4.5 year commitment that we can make. Beyond that, we don't know. We just honestly don't know, right? We don't know if there will continue to be a need. But, the likelihood of recruiting, I think, some good folks that to make, again, a commitment for about a 4 to 4.5 year period of time, I think we could get some good folks here. I know, again, at Tri-Board, we had, shared anecdotally some of the trends that we're seeing, but I even see it in my office. I've been, working full time in local government now for 20 years, and with my part-time work, 25 years. And, there were certain things that would sort of make their way to the town manager's office, maybe a handful of times, during the course of a year. And particularly since late summer, just seeing those types of situations escalate where they're reaching my office again with people who are just, again, struggling with mental health and well-being issues. Sometimes it's every week, sometimes it's every day. And it used to be a handful of times every year. So again, that's just sort of some anecdotal, sharing of what we're just seeing people struggle. So in terms of pandemic recovery, it's just something I'm really passionate about. I think our social services director with assistance from our chief have put together some good information and data we'll be able to share on the town side of things. I know that Susan and Matt have done the same on the Board of Ed side. But in terms of really thinking about recovery and how we come back from this, again, the mental health and well-being is just an area that I think is very important.
Yeah, thank you. I mean, we're certainly seeing that in other ways, but so in terms of certainly capital and not creating cliffs, we also do have to meet needs. And so I think taking a measured approach and doing it over a 4-year period and with the expectation that those dollars may or may not be there is a reasonable approach from where I sit. And so I'm certainly going to be open to that and look forward to seeing your data and analysis there. Are there any other? And the other thing I just want to give a shout out to both Matt and Maria and Wendy and Susan is really taking the time to budget ARPA dollars in the current budget and do it part of the budgeting process so that the public will have an opportunity to vote on it. The normal way we appropriate money is through the budget process, and it's the most comprehensive place where you can see it all in one place. If people want to know what you're spending your money on, you go and you look at the budget and you can see it all. And so I do appreciate the effort to do it through the budget process. And I think that's a very good approach, and it's very transparent. And it means, truthfully, that it's not us who's going to approve it, not our board, not your board, but the people when they vote on it. And so that's a great way, I think, to view it and to use it strategically. And so I do appreciate the effort. I know Maria shared with me through the ARPA work group some of the things she's thinking about, and they're all very reasonable. Whether they make it, I assume there are going to be some adjustments there based on what she hears from staff and from the Board of Selectmen and from the Board of Education. But what I've seen, and having gone to a lot of meetings, everything that's being put forward is all reasonable. I'm not seeing any things that raise an alarm or a concern there. And it's really, the trouble is sort of how do you prioritize? Because there, even with $11 million, there's probably going to be more needs than we have revenue to deal with. But we should be able to take care of more than without 11 million. So we're, I think there's an opportunity there as we look forward to that. But, in the long term, how do we budget, like as Art said, is a good year this year? What if that had come in negative? What would we do? What would our process be? And is there any way to get a better process so that we can set expectations? It's like buying a car. My son went to buy a car, and it was as if he went into the car dealership and they said, "What do you need?" And he told him, boom, 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 boom. And the guy said, "Okay, it's $40,000. And Rob's like, "No, I don't have $40,000. It's like, "Well, why didn't you tell me your budget before?" So it gets very complicated to do that. And I don't know if there's an answer to it because of the way the charter is and where we get estimates from the DMV and the timeline. It may just be something we're constantly grappling with, but there should be some systematic way we can think about it. And what do we do if this scenario happens, or if this scenario happens, and how do we deal with it? And I don't have an answer for that, but that is something if people could give thought to, at least the next few months and perhaps over the summer, we can talk about a new process. I know Susan and Matt find that particularly hard because they get the revenue numbers in February. So
Lisa, can I?
Yeah.
Can I? So I wanted to just comment on Derek's comment from before I lose track of that about the ARPA funds. As everybody knows here, the last half of 2021 was spent trying to figure out how we were going to deal with the interim final rule and follow all the rules and regulations that we had to spend the money. And now we all know about the final rule and things are a lot looser. But as far as spending the capital, I'm not sure that any of us are thinking we're going to blow that whole $7.5 million during this budget cycle. I mean, that's my perspective is we don't have to. We've already gotten 3.7 million in. And I believe, Amy, we're getting 3.7 million in sometime in June, which would be the next bunch of money. So theoretically, we could do this next budget cycle if we want to, because it's still within the 2024 timeframe. So it doesn't all have to be spent at this budget cycle. And I think we should be conscious of maybe keeping some money held back for anything that does come up as an emergency need, and to do a supplemental appropriation, or to maybe just keep it on track for next year. If, like Derek, you said, costs this year are prohibitive to do certain projects that we have on tap, maybe we put them off till next year. So I think we're all pretty conscious of following that. At least I know that I am. I'm not trying to spend it all this year, especially given the grand list growth that we've had. If that didn't happen, maybe we would have been in a different position. So
that makes sense. I mean, I think it's good to be prudent and slow, and that's all the advice and everything I've seen you guys, the three boards are doing that. So keep on. And
I'm one of six, so I just have to add that here.
But I think like Maria and Susan's boards and the Board of Ed and the Board of Selectmen and Wendy's boards do some of that long-term planning. And so we don't, just because you sort of plan for it doesn't mean you have to spend it in this year. I think Maria's plan, like the social worker she just mentioned, is going to be spent this year, next year, the next year, and the next year. So there will be some, it won't all be expended in the current year, but there will be a plan to do it, which makes sense. And that plan obviously can be adjusted if needs change, just as the CIP is adjusted each year if needs change. So that what you're doing, I think, three boards, the two boards, and then coming to us does make sense. Everything I've seen so far, and appreciate everyone's thoughtfulness on this. It's a lot to balance, and especially you guys are getting a lot of input from the public, and so.
Lisa, I was just going to say, you all are talking about the projections and trying to have a better process, and I think you, Lisa, Linda, me, we've been around doing budgets probably together for a very long time. And nobody wants to get a budget pushed back at them, but we always budget with the least impact, with the best programming we can. That's just how we formulate the budgets. We're always trying to serve the students, do a good return on investment for the residents, And I think had the grand list projections come in differently, we would have had to make a pivot. We've done it before. We've had reduction lists under Diane Ullman, years and years of looking at budgets and relooking and where to make cuts and trims. So not that we would ever want to do it, but I think to remember that projections are just that, they're projections. And I think everybody's probably doing their best, and the used car prices stunned everybody in this pandemic. So I think that's just kind of an out of left field thing that we all got lucky with. But I just wanted to say, certainly our budgets are always done prudently and with respect for the taxpayers and our students and our staff to try to put it all forward.
No, I think all three boards really, that's not any one board's priority. I think that's all three boards.
Sure, absolutely. I don't mean to say that's exclusive to any of us.
No,
Sorry.
sure. We're very appreciative of that. The question is, at the end of the day, our board has to decide, okay, is this something that residents can afford? And that's always
Right.
That's a tough call. This year it's not, because it looks like this year could be the nicest budget we've ever done. But
Thank God for that.
and I'm feeling optimistic there, and I'm hoping. And if for some reason we can't come in, or if we think we're not going to come in with a flat tax, let us know, and let's come together and see what we can do to get it there, because I think that's going to be the expectation from our residents in any event. So those are things we look forward to. We did have some requests, but Maria's seen them, and I think I've talked with them and Matt for the budget, so I think we're set there. So does anyone have any last comments before we move on to health? And so first of all, thank you, Susan. We really appreciate you coming. I think it's really great. And then, in the future, we can add more, any of your board members are always welcome. Same with Wendy, happy to have anyone. And if there's something you think we can do better, or you want to add to the conversation, or the process can be better, let us know, because we're open to it.
We're always happy to work with you guys. Thanks
Thanks.
for having me tonight.
Okay. All right, so I think we'll move on then to the draft health insurance fund policy. As Amy gets ready to introduce that, I do want to just remind folks that we do actually have a little bit of a policy in our current fund policy, fund balance policy on internal service funds, where we have in that policy, they should always be at 20 to 25% of expected claims. All right, Amy, you want to tee this up?
So Tim Hasselman is here from Lockton. He's the one that actually did a draft policy for us. So he can take you through some of the highlights of the policy and why things look a little different than what I tell you every single quarter about being at 20 to 25% of expected claims, why it's at 30%, what the thinking is, and some of the rationale behind that decision making. So Tim, if you're ready to go, I'll turn it over to you.
Thanks, Amy. Appreciate that. Good evening, everyone. As Amy mentioned, the town as well as the board reached out, and we had several discussions regarding the health fund and the status of the health fund. As part of that process, I questioned whether or not there was a formal document in place, and we kind of talked about that a little bit. And I had kind of helped set policies in other towns, helped draft policies, and they always get tweaked by the individual town and board. But what we put forth was something for Simsbury to consider, having a document in place that actually addresses, a target range for the fund, what the fund should be used for, and then what happens when the fund either runs in a surplus and or a deficit position. So, our estimate when we look at a health fund policy, we typically recommend a health fund that should equate to roughly 25 to 30% of the expected cost within a given year. And the reason we come up with 20 to 25% is because claims are going to fluctuate. We locked and worked with the town of the board to set a budget for the health fund, including the medical as well as the dental plans on an annual basis. However, there's going to be fluctuations in those costs from one time period to the next. Typically, they're not going to be significant, but we also want to make sure that Simsbury has enough in their health fund policy in a given year where claims do not run very positive. So we recommend an expected margin in the fund, and our margin estimate is between 20 and 25%. In addition to that, the plan is under a self-funded arrangement, meaning Simsbury pays the claims on behalf of members that are covered under the plan. There's an inherent liability from when claims are incurred until when claims are paid, which referred to in the industry as an incurred but not reported reserve, an IBNR. Typically, that IBNR is roughly in the 10% range. So when we recommended to Simsbury putting forth a policy in place, our expectation of that, the fund balance should be roughly 25 to 30% on an annual basis. We also recommend that you guys consider this health fund consistently throughout the year, and at budget time, determine whether or not that fund should be either replenished if the fund is running low, or if the funds can be used if there's a surplus balance. So within the reserve document, we had kind of provided the language surrounding on who could make the suggested changes in the health fund and how that would take place. The fund, when we look at the fund should be used for overall claims that are paid out under the medical plans, as well as the dental plans, and then for the fixed costs associated with it. So that's kind of why we put the policy in place. The one other thing to mention, and we've done this in other towns as well, is if the fund does run low, Simsbury should consider, or even if the fund is in a big surplus, Simsbury should consider utilizing a portion of that fund balance or replenishing a portion of that fund balance over a time period. So in other words, if the fund is short by 10% in any given year, maybe not making up the 10% in one given year, but making it up over a 1 to 3 year period. Kind of something that we put in place in other, or help towns put in place in other municipalities, and something that we thought we would recommend to Simsbury as well. Questions or comments regarding the policy that we drafted as a document for Simsbury to consider?
Open it up to questions from the board.
I have a question and then a comment. The reserves, where do they sit, and is there any return on them while they're sitting there not being used for claims?
Amy, I'll let you answer that one.
Me question. Yeah. So our reserves are with our other funds that are in excess, like our general fund reserves, things of that nature. They are within STIP and money market. So they are earning a return.
Okay. I guess, I worked in the health insurance industry for many years, and I just never remember with any of our self-insured clients recommending that they have reserves greater than 1/4 of IBNR. And so we've always heard 20 to 25%. So I'm just a little surprised at the change in recommendation to that. Is that a change in industry standard? So where did that come from? Because it's been 3 months worth of claims forever and ever. And now we're saying 30%, which is more.
Well, so 3 months of an annual claim number is roughly 25%.
25%, right. So
yeah.
How did it go to 30?
Well, we also recommend, in addition to having the 25% for a claim corridor, we recommend an IBNR. The IBNR that you had mentioned, maybe I'm misunderstanding your.
It is the IBNR, yeah.
Yeah, the IBNR in today's environment, because claim payments pretty much become electronic, especially on the pharmacy side. Claims are pretty much paid the same day that they're incurred. The IBNR is actually shortened over the years. Typically, we used to see 2 to 3 month lag from when a claim was incurred till it's paid. Now we typically see about a 1 month lag. So that actually is shortened. The 25% more or less is we're recommending higher than just the IBNR because your claims are going to fluctuate from one time period to the next. In other words, I could sit here. Oh, excuse me. Sorry about that.
No problem.
I don't know if I'm back on or
No,
not.
I get the fluctuations, but I mean, something I've been concerned about with multiple different topics on the Board of Finance is not wanting to have multiple different reserves. You know, we have a big reserve, and then there are other pockets of little, you know, capital reserve and this reserve and that reserve, and I am a conservative person, but from a taxpayer perspective, that's tying up a lot of money for just in case when we've already got a just in case, which is our general fund reserve. So, you know, if there were no other reserves around to tap into, I'd be a little more comfortable bumping it up. But I'm just, you can try to convince me. I'm open to that, but I just don't. I don't off the cuff have a comfort level with putting more money in reserves because that's just taxing people more.
No, very, very fair point. And, you know, again, our recommendation is that 25 to 30%, not knowing what other fund balances you have and that you could pull on or pull from in any given time frame. So, you know, we look at overall projected health costs for the coming year, and overall projected health costs for 700 members or 700 employees covered under the board and the town plans are roughly $16 million. So you're probably right. The 20% may be a little, or the 25 to 30% may be a little high if Simsbury has funds that they can pull from other sources. We recommend just from an overall health fund policy. We're not taking into consideration how quickly you can move money.
Yeah. And I think we need to look at it from a bigger picture. And I understand you're looking at it from a very narrow picture. Okay, I get it.
What is the total? If it's 20 to 25%, what is the total number?
That would be roughly $4.5–5 million.
Okay. And so to go from 20 to 25 is just $1 million or less than $1 million?
Yeah. So if we look at the overall health expenditure, I use claims are roughly 16.3 million. We've got expenses under the plan of roughly 1.5. So call it 18 million. 5% on 18 million is roughly 900,000.
Okay. Are there any other questions from board members?
Well, I have a couple of other comments on the drafting of this, but I don't know if you want to go there yet.
We can go there. I have a few questions as well, but go ahead, Linda.
You go ahead, Lisa.
One of the questions I had is, one, Maria had mentioned we don't use aggregate stop loss because it's very expensive. And part of the reason we have reserves is because we don't have the aggregate stop loss. Under what circumstances might that calculus change where it makes more sense to have aggregate stop loss? And can you speak to that a little bit?
Sure. Aggregate stop loss actually is not that expensive. We look at it, for somebody of Simsbury's size, we see aggregate protection probably costing somewhere around $60,000 to $65,000 on an annual basis. So it's not, when you consider $18,000 or $18 million, it's not a significant spend. That being said, from a experience standpoint, I've been doing this for quite a few years, 20 plus years, and I've only ever seen one aggregate hit, and that aggregate hit was for a case that was roughly 1/2 the size of Simsbury. If you look at Simsbury, Simsbury has about 675 employees covered under the medical plan. The ability to project claims from one year to the next is pretty consistent. So I don't necessarily think aggregate protection would be a good buy for Simsbury. Granted, it's a small amount, but I wouldn't recommend that it would be a good buy for Simsbury.
And you'll advise us if the circumstances change.
Oh, definitely. Okay.
And then just a basic question. On page 3, you are recommending, what the excess reserves might be used, and you include non-health related expenditures. So what kind of, we had been advised in the past that you could only use it for health related expenditures. So what is permitted there?
Yeah, again, it's a policy that would be adopted by Simsbury, but what I've seen happen from other municipalities is they use it for OPEB funding. So if there's a overage in the health fund, that would be used for other not health related, but OPEB was one big thing that I've seen in the past.
Yeah, that's something we've done in the past as well. Okay, but
Yeah.
it's not, you wouldn't use it for operating expenses in the budget.
No, typically no.
So that might need to be clarified in this policy, because it reads that it could be used for non-health, and I would want to limit that, I think.
Yeah, that was
Fair.
my too. In Roman numeral 6, it talks about use of the fund for non-health insurance related use. I was like, what? Like what?
It gives you flexibility. I guess that the wording that we drafted gives you somewhat of a flexible arrangement, but again, that's Simsbury's choice.
Well, I think there's probably issues with the employees too. Don't they contribute? And so you can't just start using their contributions for, building repainting the bridge or something.
Right. So that's one perhaps edit we could do. Linda, you want to go through your edits? Do you have others?
Yeah. Well, just on Roman numeral 5, kind of going back to the target range. You talk about 30%, but then 4 times the monthly average, which is actually 33%. So I'm more comfortable in the 20 to 25%. And I would suggest we look at it as a range when you get to the part on the last page about, what to do when you have a deficiency, that, you don't want to have to react the second that you are, let's say your target is 25%. If you just pick that number, if you get to 24.9, you don't want to have to react. You want to arrange so that if you're somewhere in that range, because of what you said earlier, you always have these fluctuations, even just seasonally. That claims are much greater in the winter than they are in the summer, and that's a significant change from every year. So you want to range so that you're not having to take action to put more money in or take more money out every time there's a little fluctuation during a year.
Okay. Yeah. I mean, again, the way this was drafted, it was, we were looking at it between the 25 and 30%, but that can definitely be taken into consideration.
Yeah. And my other comment, I think Lisa addressed, was, the very almost last thing in B, what to do when there's a surplus. It just says you'll make recommendations. I think it'd be useful to list off, what some of the options are, because we're actually at the point where we have a huge surplus. So we need to know that now.
Okay. Yeah. And we, some of the other municipalities that we deal with have utilized the reserves to offset the health funding for future years as well.
Sure. And that's absolutely where I think we'll end up going. But
yep. And again, that's
good to put that in the policy.
Okay. And
that's something we can do in this budget cycle. I mean, obviously the healthcare, we're coming in flat this year, but should we be putting some aside for future years as well?
Definitely consideration. I don't know that what the reserve balance is at this point in time, but it would be a consideration for sure.
We're at 45%.
45%?
Yes.
Yeah, I don't know that I would recommend.
No, Tim, the 45% is as of the end of December 31st. So there's timing differences in payments and premiums coming into the fund. So we're projected to be about 38% at the end of the fiscal year.
Okay. Yeah, and again, when I look at it, I guess I would look at, if it's 38% and we're targeting, let's just say we're targeting 30%, I would take that differential and call that 8% differential. And I would probably look to utilize that differential and adjust the funding going forward. And I would not recommend utilizing the whole 8% in one given year, because claims are going to move. And in addition to that is, if you use that 8% all at once, go back to that cliff discussion you had earlier. Next year, you're 8% down. That's going to be a big swing in your healthcare budget.
Got it. All right. So Amy, are you comfortable flat? Are we, if we, for next year's budget, if we come in flat, you're comfortable with the reserve level?
Maybe. So Tim or Locked In, Rebecca typically give us projections again as we get closer. We only have their preliminary projections. So once we see that their final projections as we move along the budget process, I'll be able to evaluate. But as of right now, with what we have, yeah, I'm okay with it.
Okay. And Maria, did you want to chime in on that?
Yeah, get my general comfort level, having managed, self-insured funds for quite a long time now, as Tim said, 25 to 30%, just based on, sometimes you get unexpected, situations that you maybe couldn't have anticipated. Again, my comfort level is more in the 25 to 30% range based on experience. And that's what I would recommend.
Okay, so we generally, there were some suggestions for minor tweaks to the policy. Is that something Amy and you would like to work on with the uses of the funds? And what was the other one, Linda, you wanted?
Well, yeah, I'm more 20 to 25% person, and also just making it a target range, not a target level.
Yeah.
Target range.
And getting rid of the non-health insurance related uses. So I don't think we can do that.
Okay. So with those three changes, I mean, we generally put a policy on, we don't do anything with it for at least a year, a month. Is there a rush to do this, or can this wait until the summer when we generally do our policy review?
I don't think there's a rush. I think our fund is in a very good position right now. If there's time to wait, I think it would be now. And then on top of that, between the projections that we have for fiscal year 22, since we're closing out our budget process, we could probably come up with something for 23 and 24 to get a sense of where our reserves are going to be at before we make a final decision. So I'm fine with that.
Okay. So why don't we do that? If you guys can work on just tightening up the budget. We have a recommendation 25 to 30. One member wants us to do 20 to 25, and we'll further evaluate that as we see what our general fund reserves are, or whether we're going to make a pension contribution. But I think we've got a good recommendation to work with, and it's very close. So I don't see this being very controversial over the summer, but we'll finish it up over the summer. All right. No objections to that. Is that right? Just watching. Okay. Thank you very much for coming in. We appreciate the work you did on it and the thoughtfulness and the explanations. That was helpful. Before we move on, did Bert or Mike or Art want to add anything?
No.
Okay. Then we will move on to the Finance Director's report. Amy, you want to start us off?
So a couple of these things we already talked about, so to save some time, I won't go through each one of them. So the ARPA update, Lisa, you addressed earlier. The anticipated increase in interest rates, this is something that was brought up at the last meeting for staff to follow up on about U.S. Treasury's proposal to start increasing interest rates over the next year considerably. So I did reach out to Barry Bergabi, who's our bond advisor with Phoenix Advisors. He was hearing the same thing. He kind of made the caveat that, we can't predict interest rates. He's like, but his feeling along with his colleagues is that the interest rates will increase. But comparatively to the long-term historic perspective, he thinks that the rates are still comparatively low. And then his final caveat was, because I asked about, should we think about borrowing money earlier? Should we just stick with our current schedule? He feels that borrowing money should only be done when needed, not any sooner. So those were his thoughts on the interest rates.
Amy, can I ask a question? when interest rates change, it obviously affects both borrowing, but also what you earn on reserves. So if interest rates, well, which they will inevitably go up, is that a net loss when you balance those against each other? You know, how much more we're going to incur in borrowing costs versus how much more we're going to make in investments?
I mean, that's a really good question. I don't know offhand. I've never looked at it. It would probably be interesting to look at. I guess my initial reaction is, depending on how good the interest rates are, I mean, perhaps we could, I mean, it wouldn't offset the long-term interest, but perhaps it could offset, you know, the borrowing costs, which are tens and thousands of dollars themselves. But yeah, I've never looked at that.
Because most of our investments are, you know, conservative in things like T-bills and stuff. So,
Right.
we had such depressed earnings for so long because of those low interest rates. You know, this might not be a disastrous thing for us.
Yeah, no. Agreed. The pension liquidity was discussed during the FIA presentation, so I'll skip over that. And then the Board of Finance budget meeting dates. I reviewed this with the Deputy Town Manager, Melissa Appleby, to come up with an additional date for the Board of Finance to convene prior to sending the budget to public hearing. So the Board of Selectmen presents to the Board of Finance on March 22nd. The only date that we could make available for the Board of Finance to have an additional meeting prior to sending the budget to public hearing would be March 23rd. And that's because the Hartford Courant has to have everything the morning of March 25th. So if you all wanted to reserve that date, just let me know and I can add it to our meeting dates. Alternatively, when the Board of Selectmen presents on March 22nd, you can make any adjustments then that you're comfortable making, send it to public hearing. And then this gives the Board of Selectmen, I think from the 6th to the 18th of April, to go back, reconvene, adjust, and then come back to you all at your April 19th meeting for another look.
I mean, why don't you go ahead and add a special meeting on the 23rd, just in case there's something comes up and our board needs additional information that could be given to us the following day. That's an extra day to evaluate that.
Okay. And then the last item is the budgeted vacancy rate. Maria is aware of this request. I followed up with her and we are putting together information for her budget presentation. So that will be forthcoming.
Great. Thank you.
Thank you.
All right, so let's move on to the quarterly budget status report. And I want to thank Amy. This is our first stab at the new format. Would like to get people's input. I want to thank Amy for her work on that. Whenever you switch formats, it can be a little bit tricky. So thank you. Kudos to Amy for pulling that together. And as I can't remember who said last time, it's a work in progress. So we'll continually find what our members find useful. And this is not that boring art.
I'm with you. I'm with you. I'm with you.
Amy, why don't you start by walking us through it, and then we'll take questions from members.
Do you want me to just run you through the presentation of it or the highlights of it?
Just the highlights.
Just the highlights.
Yep, so let me share my screen. Hold on. Okay, so starting off, just as a quick overview, this is the General Fund Summary tab. And then you have your detailed revenue tab here. So the only highlights I have here, I'll try to make it bigger, is related to the building department. As you can see, we're at about 41% of the budget received. So we did increase our budget this year to about $838,000, given that we did have such significant building permit revenue at this time last year. Those projections are not coming to fruition to date, although the majority of our building permits will likely be issued in the spring. So just wanted to highlight that. And then on to the town clerk, the 466,875. So you can see we're at about 72% received to date. So this is obviously over 50%. So we're seeing a slight increase here as we did last year as well, related to our conveyance fees. And then under the town manager's office, you can see that there's a 90% increase here. There was a budget for state money of about $35,000. And then this got increased to $98,000, I believe. And then there was another municipal revenue sharing that was supposed to be coming from the state for about $174,000. So these projections were done. We were anticipating getting all of that revenue. As of recently, I think it was about a few days ago, we received notification from OPM that municipal revenue sharing money may not be coming. They said it was delayed. They didn't say we were not getting it. But the way that the letter was written, there's a chance that we might not get it. So just be keeping an eye on that.
Amy, I didn't see that budgeted, that revenue sharing in the budget book. They had under the town manager revenue pilot, telephone access grant, Westminster, Worldskate, Simsbury Performing Arts Center, rental fees, and miscellaneous. So what is the revenue sharing?
So this is something that we didn't budget for. This is not something that we've ever gotten. It was something that was proposed as the governor's budget last year, $174,000, and it came out after we were done with our budget, essentially. So it never made it into our projections, but it doesn't sound like we're going to get it anyways, though.
So that number is going to, that projected number is going to come down.
Likely. Once we receive verification, I'll adjust it.
Okay.
Moving on to public works, you'll see about $101,000 here compared to our minimal budget of about $500. This was some FEMA money that Public Works had applied for one of our previous storm cleanups a while ago. And the money was just approved and came in now. And then under the Parks and Recreation, this is a little low. This is just a timing. One of our journal entries was done in January as opposed to December, so that will true up. There's no issue there. So I just wanted to point that out. And then the last item, the last item I wanted to point out was the Board of Education. So this is where we record our ECS funding, which is typically received around now. So STIF actually changed banks. They've moved from BNY Mellon to a different bank. So we haven't received notification that this funding has been sent yet, although I'm sure it has. So likely that'll be posted probably for January, February. So just trying to track that down before we post it.
So then, Amy, when you go to the bottom, we're looking at a net positive revenue of 1.6 million. Some of that is the tax collection assumption rate that we plan for, right?
Mm-hmm.
And some of it are the excess revenues that you were talking about. One of the things as we think about over the next 3 years, the difficulty with grand list is, do we want to adjust the tax collection assumption rate? I certainly don't want to do it this year, but over the summer, as we look at policies, that's something we should talk with our bond advisor about and consider adjusting over time. So I just put that out there. We try not to adjust policy in the middle of a budget, but we could look at that next year, especially if the tax collection assumption rate is coming in higher than we had initially thought.
Moving on to our general fund expenditures detail. You can see just starting at the bottom line, we're about 47.22% spent, pretty comparable to last year, is about 49%. The major driver here is this line item for the transfer out to the capital reserve. So this is something that was done after we had closed year end. In the prior year, we had moved out $2 million to the capital reserve. So obviously that's non-recurring this year, and therefore it shows $2 million less. The only other two things I wanted to point out that I highlighted, they're super small. So right now our legal services, based on projections, it looks like we might end up a slightly over at the end of the year. And then again, just super small dollars, but our public building commission had about $2,600, where I think a conservative, actually probably not even conservative, $5,000 projected. So we might end up over there as well. But again, less than $10,000.
Amy, we're looking at about 600,000 in budgetary saving projections right now, right? And can you just highlight where those are in general government, public safety, building maintenance, and library? So are those mostly new positions opened?
Hold on, my notes. So one of them is the assessor's office for about $90,000 savings. This is that temp position that the Board of Finance approved last budget cycle. We are definitely having issues filling this position, being on a temporary basis with no benefits. We are not having, and then in and of itself, being in the governmental industry in assessment in and of itself has been very challenging to recruit people. So that's the majority of the savings there. Moving down to general government. About $35,000 savings. This is just based on our rate of spend for our postage and then our conferences and education. And obviously due to COVID, there haven't been as many conferences and education. So expecting some savings there as well. Down to the police department, about $60,000 in savings. So this is their gas account, which is going better than anticipated for this time of year. And then on top of that, there's some savings anticipated in the holiday pay. So in prior years, we fund the holiday pay as the officers have a choice between taking the holiday pay and I believe taking earned time. And so we always fund a portion for those officers that we think are going to take the holiday pay. And it just seems this year, up to this point anyways, that not all of them have taken the holiday pay. Moving down to buildings and maintenance for the $61,454, we did have a manager vacancy in this department until pretty recently, I think within the last month or so. So that was just a staffing transition. And then under culture, parks and rec, same thing here. We are seeing some transition over at the library for a couple of our positions. And I think those are the major ones.
The one thing I'm just point out is that transfers within a department, so we shouldn't count on those as being true savings because transfers within a department can be approved by the Board of Selectmen without coming to the Board of Finance, so long as they don't go over the departmental budget. So if there are needs within a department, those savings may be captured at the department level and may not be true savings at the year-end close. So just a highlight to folks on that.
Moving on to our Simsbury Farms Fund. At the end of December, seeing about a net income to the fund of about $177,000. The majority of this relates to our special programs and our day programs. You may recall that last year during COVID, a lot of these programs were either reduced or canceled altogether. So we are seeing that natural increase as our programs are running almost back to normal, essentially. And then we also had some additional activity at the pool, pretty much for the same reason. It was definitely reduced last year during COVID, and patronage was monitored. And I believe that there was a system for those going in and out of the pool, and you had to make reservations in advance, things of that nature, which restricted access and therefore restricted usage at the last year.
Amy, just a quick question on the use of parentheses. Total revenue, you've got it 43,442. It looks like it's a. What do you mean by the parentheses? There's less revenue or there's more revenue than budgeted?
So I kept this the way that the document had it. So the way that they're showing it is it's the budgeted revenue minus the projected. I typically like to do it the other way around. Essentially, yeah. So essentially, we're just the negative is a good thing in this case.
So negative is a good thing in the special revenue funds, and the non-negative is a bad thing. But is it the same in the expenditures? Is the negative bad?
No. So in the expenditures, negative is bad, and positive is good.
So negatives. So narratively, what is the state of the special revenue fund? And can we do this a little bit more clear?
I can change it however you want. Like I said, this is my personal preference. I like to see the good being positive and the negative being bad. So if you all...
yeah, I like that better.
Okay.
So do I, yeah.
So for the projected at the end of fiscal year 22, it's a good thing. So anticipated to be about $30,000 to the good.
Okay, perfect.
Just make a note on that before I.
Yeah, it just threw out on the special revenue funds. That got a little confusing.
Yeah. So the projections, I'm sorry, that was the budget. The projections through year end anticipated to be about $100,000 to the good. Obviously, with the caveat that, as the spring comes, a lot of these activities are weather dependent and there could be some fluctuation there. And then lastly, I just wanted to touch on the health insurance fund, our favorite fund of the evening. So right here for our premiums, we're a little shy of where we were last year. Again, I think that this is just a timing issue of when the transfers were done. And then down here in the opposite direction, we had booked our claims faster than what we were taking in our revenue. So it is showing a loss of about $788,000. But again, these are all timing issues, and I actually expect us to be to the good by the end of the year of about $1 million, a little over $1 million.
That gets us to the 38% reserves.
It actually gets us higher, but I haven't done the formal calculation yet.
Oh, higher. It'll be 38 if you use some to offset the increase, though. Okay.
Yeah.
Amy, I have two questions on your summary thing. One of which is on the health insurance fund. It talks about the 45%, and okay, that's timing. But it says the town's health insurance consultants recommend reserves at 20 to 25%. Is that a different consultant than the guy that we just heard?
Oh, same one.
So that's different than what he said. He said 25 to 30 just 15 minutes ago.
Right.
So for the policy, he's recommending 25 to 30. The 20 to 25% of expected claims is where we should be at for our fund. But for our reserve policy, we should never go below 30% because that extra 5% includes the IBNR.
Ah.
Well, that's a little confusing, but okay. And then my other question was about the 18%, that last line on page 40. Says based on the projections, the fund balance is estimated to be 19 million or 18% of budgeted expenditures. Is that a current figure or is that a year-end projection?
That's anticipated for year end.
So we will be actually above our guidance in terms of how much we would have in our reserve funds. Okay.
Linda, that goes to what our actuary was saying. It might make sense to do an extra contribution to our pensions, and that would actually, in our current policy, does highlight that as something we should do if you go above at 17%. So,
Right. But I also would be inclined to be thinking about what we talked about earlier, designating, and I forget how we did that for the Hartford, even though we didn't end up using it, but designating some portion to help with excess capital needs in the next 2 to 3 years.
I think that's worth looking at as well. That makes sense. And so, Amy, to the extent you can start thinking about that for the budget process recommendations, what to do if we do hit 18%, Linda's, or whether we should do a pension contribution or some other.
Yeah, I mean, the pension contribution, once you put it in there, you can't take it back out. Whereas if you don't end up using it or needing it for whatever reason for capital, then you can always use it for something else.
Mm-hmm. Yep.
Amy, I had a question. Can you go to the pension page?
Mm-hmm.
So I wonder if there's some way we could sort of, so we've got an actual, but we don't have a budget. Can we add a budget? I mean, I can't tell from this what's happening. Can you give me the narrative behind this?
Yeah, sure. So we've never had a budget for this fund. I think for me in particular, it would be difficult just because it's based mainly on interest, dividends, change in market value. The contributions we might be able to get close. The retiree payments, we don't know who's going to retire. We don't know who's going to pass away. I would probably have to work with Milliman and FIA to get some valid budget for these types of funds. But basically what you're seeing here is you're looking at the contributions for this year compared to the contributions for last year. So as you can see, there's a significant variance here. So it tells the story of why have we not made enough contributions in the current year compared to the prior year. So the prior year, this would be our ARC payment. Not all of it, a portion of it would be our ARC payment. And this year we haven't made our ARC payment to date. So once we get those reports from Jen at Milliman, we'll make our ARC payment, and then this will be trued up to this. The interest and dividends are pretty consistent, and then the change in market value is just that last year we had a good year. This year things aren't looking too good.
So is there some way we could get a summary of the overall health of the fund? Like the fund started out here and after all this, we're here.
So, I mean, we have like the net income loss to the fund. Is that what you're looking for? Or we have the fund balance that's included on the narrative pages. Are you looking for something different?
Yeah, so fund balance, but it's on the narrative page, but we don't know what it was the year before. So are we growing? Are we losing money?
So your net income loss will tell you that. So for this period, we lost money. For the same period last year, we made 1.5 million.
But that's a moment in time. Like, how do we know, like, projections? Are we thinking we're in good shape? We're in bad shape? I mean, how are we monitoring how we're doing in that fund?
I mean, this is how I monitor it. I'm not sure what you're looking for that would help you.
I guess I'm looking for, is our fund growing? Are we meeting our ARC? Are we, lowering the ARC because our investments are coming in where they want? We haven't had more people retire than we thought. Sort of, are we on track?
I mean, this is a moment in time, but each moment in time is where your fund is fiscally. So, we we had 1.5 million last year. We're deficit of about 250,000 this year. So if we're looking at the contributions, well, we know those are going to catch up. Those aren't a big deal. If we're looking at the interest and dividends and the change in market value, well, we're in a bad position compared to last year. But just because we're in a bad position at this moment in time, whether it be the end of December, the end of June, that's the nature of these funds. And we just want to make sure we're not in a bad position multiple years in a row. So, you're looking to see, are your revenues exceeding your expenditures? Are we growing fund balance? If we're not, then we're not in a good position.
So I look at that and say we're not in a good position for this.
For this point in time, we're not. I mean, so we'll true up the contributions when those are done, but our investments are completely off kilter compared to the same time last year. We're in the hole with our investments as opposed to $1 million to the good with our investments.
So that seems different than what Fiducian told us. They told us we're on track, we're going to make 6.5, and this is showing something different. So that what I'm trying to do is reconcile what I'm hearing from Fiducian to what I'm seeing here.
So we could probably, let me think about this for a second. So these reports come in from Wells Fargo. I guess I could see what FIA has. I mean, they have to reconcile.
Yeah, because we should be able to look at this and sort of see, okay, we're on track or we're not on track. And I don't know, maybe you can do that in the narrative, but this to me wasn't something that made intuitive sense to me, and it could just be me. But if you look at that, I don't know how we know if we're on track for the year or not, that kind of thing.
Well, I mean, I guess you could take so for me, it's, where are we going to end up at year end? And so we have our contributions, which we know are going to true up. Our interest and dividends are pretty much, stable. And then we have like the market. And I think that's where FIA does a great job in telling us where we're headed, because we don't have a budget to compare it to. So we don't know if we're doing better or worse than anticipated. And I think that's why FIA does a great job with those reports of showing us where we're at, where we're headed, and what we can expect, which gives you the overall health of where we think our fund is going.
Yeah, no, I totally get that, but like the retiree payments, did more people retire this year than we expected, or less, or I can talk with you later about this. I don't want to take up, it's too late at night.
Right.
Anyone else have any comments on the report? How it looks, the structure? First of all, thank you again for all your work on it. If there are no further questions, we'll just go to the Board of Ed quarterly.
So this one will hopefully be quick. Just a couple of items on the revenue side. So our special education excess cost grant, this is usually our most volatile grant, depending on the type of services that a student is getting, whether we qualify, whether it hits the calculation threshold. So we have a preliminary award of about $1.8 million. So this is a slight decrease of about $46,000. On the private school health services, we received our final award of $20,940, an increase of about $2,200. Our Title A, we got our final award here for $56,000, a decrease of about $6,900. Our Title III, another final award for $9,400, an increase of about a little over $1,000. And then our last final award during this quarter, second to last final award during this quarter was our Title IV for our student support and academic enrichment, which came in flat at $10,000. And then moving on to our American Rescue Plan IDEA money, we have a final award of about $245,000. We were originally anticipating $223,000. So a nice little bump there for year end. And then moving on to expenditures, I'll just give you an overall highlight. Our major spending this period compared to last period is mainly COVID. So you'll remember last year, we were setting up for in-person versus hybrid learning. We had to offer the two models. We had the purchases of our additional cleaning supplies. We had our desks, our tents, our technology, things of that nature. So the majority of the decrease in spending from our general control is mainly related to those COVID items. We had our health services increase due to some increased overtime and nursing substitutes for our contact tracing. The transportation, we had renegotiated our contract last year to help our vendor Salters get through the summer months. And then the student body activities and the community services activities, these are also related to COVID, that they weren't happening last year until later on in the year. And therefore, we're seeing that increase for the same period this year.
Are there any questions on the Board of Ed quarterly? All right, moving on to the minutes.
I move we adopt.
And
adjourn.
Second by Art, first by Linda. Any further changes? All in favor, please say aye.
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 Okay. Any,
And the dog says yes too, whoever's that is.
right. All right, and we are now on to communications. We have the assessor's grand list report. Why don't we go through that real quickly? Amy, you want to start us off?
Sure. So Francine put together a memo of where our grand list came in at compared to the same period last year. So it shows our overall increase, our percent increase, the 3.72 that you've been consistently hearing, what it does for our dollar values. Under the real estate, we had a 1% increase, and she listed all the new developments and what was added to the grand list to come up with that 1%. It talks through her projections versus her actuals. She gives a breakdown of a comparison of the real estate gross assessments by property type. And she noted the top 25 taxpayers, any of the personal property exemptions that we have. She did a nice summary and then a detail behind that. And then she gave the approved abatements, the abatement value, the revenue loss, and then the last fiscal year of the abatement. And then finally, the property tax relief programs that we noted, these are just projections since the homeowners have until May 15th to submit their applications for tax relief. So that's just an overall summary of what's included. I don't know if anybody has any questions on the detail. I will try to answer them. If not, I will follow up with the assessor.
One question I had, I know that the applications for some of the tax relief open February 1st through May 15th, and I was wondering what communication plan we have to let people know that that it's open and that folks can apply.
So it's posted on the website, and then in addition to that, everybody that had previous applied, they all get a letter in the mail stating it's time to reapply. And then there was one more thing that she told me. It's not a press release.
Could we do a press release? Because there may be, like I ran into a constituent who had no idea this was even offered. And she said, how would I know? And I said, well, you call me here, let's go on the website and we'll look at it. But is there a way we could put out a press release and let people know that this is available and now is the time to apply?
Yeah, I can check with Melissa to see if she sends anything out.
Okay, thank you.
Maybe something out through the senior center.
Yeah, and their newsletter would be good. And Amy, what is the elderly homeowners net grand list?
So that's something that's used for state reporting purposes. They're required to break it out when they submit it to the state. So this is just all of the elderly homeowners' property values less their tax relief amount to get to the net.
Okay. one of the things that was sort of interesting in this, and thanks Francine for putting it together, the exemptions for our businesses are so much more than our elderly and disabled. And that stuck out to me as a little bit stark. But, and also people, if you look at the top 10, you'll notice how many of them are apartments. That's the other thing that struck me in seeing this. Does anyone else have questions or comments on the grand list from Francine? I think I've worn everyone down. Okay. We have a motion to adjourn.
I move that we adjourn.
I second.
Bert, second. Okay, all in favor, please say aye.
Hi.
Aye.
All right, thanks everyone.